potential. Inflation remains sticky. Paradoxically, that good news on growth may be bad news for the market if that implies the Fed is not going to cut as much and as soon as people expect now.
So good news would be bad news. Here's the latest. Investors preparing for 2 rounds of Chairman Powell testimony on Capitol Hill and US payrolls to round out the week. Joe Lavorgna of SMBC Nikko Securities expecting the job market to cool off, saying this: temp hiring has been falling almost uninterruptedly since March 2022, suggesting that the recent uptrend in private payrolls will eventually reverse. I'm pleased to say that Joe joins us now to look at that labour market. Joe, let's go straight to it. Friday then, would you expect weakness or is that too early?
It's too early, Jonathan. In part, there's a lot of distortion with these data in terms of how the government does its adjustments. And the early part of the year is very difficult, where you have a huge seasonal ad need in January. And typically that distortion can spill over into February. Last year, for example, we had a big January job gain and another really strong report in February. History could repeat again. And this year we had another very strong January job report. And potentially we're going to see over 200,000 jobs again on Friday. The temp hiring I like because that tells us where future demand is, and it's definitely slowing.
Ultimately, you believe that the reinflation risk remains low still, even with these recent numbers, even with the easing of financial conditions. Is that all about the labour market, in your view, going forward from here, or is it other things as well?
No, there's other things as well. I mean, people talk about financial conditions easing, and they have eased for investors. Credit spreads have tightened. The equity market has zoomed higher. But if you look at U.S. households, Jonathan, they're paying record high mortgage rates still, credit card rates, auto rates, personal loans. Commercial banks are tightening lending standards. The yield curve is still inverted. That suggests financial conditions are still tight. On the inflation stickiness story, I don't understand that argument at all. We're importing deflation from China. Commodity prices are down sharply. We know that rents are going to moderate significantly, according to the BLS's own data. Core and headline PC year-on-year numbers, which is what you want to look at because of this possible residual seasonality at the beginning of the year, those are still coming down quite sharply. So I don't understand the sticky inflation argument. If there's a concern about equities, it's just that they have gone much further ahead of where fundamentals suggest. And if there is still a recession at some point, the market hasn't priced it.
Joe, do you think then that the Federal Reserve should be cutting rates more aggressively at this point?
Yes, I've been arguing for some time, Lisa, that the Fed was going to break something. They did last March with the regional bank crisis. They've taken rates up too far, too fast. We know inflation peaked in June of 22, just when the Fed began its first of 375 basis point rate cuts. Core inflation peaked in September 22. Given the lags, yes, I think the Fed has gone too much, too far. One of the reasons there has been a recession is companies have been able to lock in those low rates. And according to my calculations, we've spent over $3 trillion of excess federal spending relative to baseline in the last 3 years. So that's helped. But it doesn't mean there isn't weakness below the surface.
Often rate cuts are portrayed as something of a political decision. And currently this week, we will be talking a lot about that with Jay Powell on the Hill, talking to the House and then the Senate. Some people saying that if the Fed were to cut rates aggressively ahead of the election, that would help Biden get reelected. How do you view this through a political lens? Do you think that is relevant in this sort of calculations here at a time where nobody wants to be accused of political bias at the Fed?
I do believe it's a factor. I mean, we've not begun a rate hiking cycle in a presidential campaign, at least since 1984. You can't really figure out what the Fed did prior to that because they didn't communicate as transparently as they do now. So there definitely is a political, I think, a part of this. And that's one of the reasons why Jay Powell sort of, I think, laid the groundwork for cuts way back in December, and why he went on 60 Minutes and saying, look, the inflation numbers have been good. If we keep rates where they are, real rates will expand, and we want to kind of get ahead of that. So, I mean, it was political, I think, in the proper way of preparing the markets for what I do think will be easing. But as you know, if they cut, there's going to be complaints, and if they don't cut, there's going to be complaints.
Joe, do you think there's a cutoff in the timeline, like the last possible moment they could before the election, so they can at least look like they're not being political, even though they say they're not even thinking about being political?
Right, yeah. June would be my guess. I mean, if you think you might be cutting in July, and you can make a case that inflation's coming down and you need to adjust rates, even modestly, why not make that move in June and then sit tight in July, which is going to be sandwiched right in between the RNC and DNC convention. So I think if they don't go by June, it's going to be a lot harder for them to start cutting.
It's funny because Raphael Bostic, Bramo, said something similar about how we could start cutting then stop. ultimately don't expect back-to-back. We don't have to do it that way. We can cut interest rates, then look around and see how it plays out.
Well, this is something that people are speculating increasingly, that basically just because they cut once doesn't mean that they're actually going to be on a cutting cycle. That, however, is not being priced into markets in any way, shape, or form, because it seems like basically the kickoff date for an aggressive cutting section. And that, to me, is really one of the key questions. Also, what is the terminal rate? We still haven't established that.
Joe, is that possible? Do you think they could cut interest rates, then just stop and not signal what comes next?
They could. I mean, it'd be unusual. Typically, you know, you've had, I calculated 4 soft landings when the Fed cuts on average about 75 basis points. So it's possible. I mean, this cycle has been so unique. They could cut once or twice and then wait and then cut again next year or cut more. So it's possible. I mean, I don't think it's likely because I do believe monetary policy is tight and there's reasons why the lags are a lot longer. I'm very troubled, Jonathan, by that inverted yield curve. And I do believe that is sucking capital out of the banking system. And there's a lot of, you know, credit crunch type and things that are happening below the surface. We're seeing more anecdotal evidence that the private credit markets are under duress. So I think they'll have to go more than 75, may even go 100 this year. But can they go and stop and start again? Sure. And by the way, I don't know what's bad about that. I don't know why the Fed always has to say it knows what it's going to do all the time and be so transparent.
I don't remember the last time the curve wasn't inverted. We'll try and find the day and dig that out.
Well, if you look at monthly averages, you have to go back to it inverted in July of 22 using monthly averages, right when inflation peaked and right when the Fed went their first 75.
Interesting. Joe, I just want to finish on the politics, the policy. I'm not going to ask you if you'd serve in the Trump administration out of respect for your current firm. I do want some details from you, though, on how you see the trade story playing out if the former president came back into the White House. Can you walk us through your experience in Trump's National Economic Council, what the thinking was at the time, and whether you think the thinking has changed, whether you think they're going to be more aggressive this time around?
I don't think anything has changed. I think, you know, the president, you know, former president has been very clear that he wants to use tariffs, but I think you have to think of the policy, Jonathan. The former president is very transactional. He wants to do deals and he wants to get things done. And the tariffs are just a means to have a conversation. As you know, sometimes he might start from, you know, the extreme side of things and eventually come back to the middle. But I don't think the trade policy will change that much. I do think you'll try to see more onshoring. You will try to see more energy production to basically try to bring some of these supply chains back. And I do think tariffs will be the negotiating point. So I think what you got in Trump 1, you'll get in Trump 2.0 again.
What is the ask then? If that's the negotiation tactic, what is the ultimate ask of China, of Europe?
Yeah, I think on the European side, certainly to contribute more on the NATO side. I know Germany has talked about it. They haven't allocated the funds, but certainly on the defense side, that's part of it. And I think in terms of China, part of it also will be, you know, it's not the trade deficits are large. Some of that Chinese goods are coming in through Mexico, but kind of maybe leveling the playing field and trying to make it a little bit more fair trade. I mean, I think the president, I don't think he has anything against free trade. It's just that he believes that sometimes we're at a competitive disadvantage because China doesn't have to hear the same kind of rulemaking and regulatory backdrop that we have. So I think there's going to want to be some changes to try to make it more even. The trade deficit improves, that's great, but I think he just wants a more robust economy. And the manufacturing sector, while it's a small piece of the economy, is highly cyclical. It has been weak, and I think he'd like to see that to be rejuvenated, if you will.
Interesting. Appreciate the input. Joe, it's good to catch up. It's been too long. Joe Lavorna there. Thank you, sir, of SMBC, Nikko Securities, and potentially the future National Economic Council Director as well. Bramo, what did you make of that at the end there?
There's a dissonance between the likes of Gary Cohn and Joe Lavorna and the way that they couch the former president's policies and what they might look like this time around, and the rhetoric that we hear out of out of Trump and what people say, which is if you take him at his word, this is what the policy is. And in the past, he has gone through with his words. So there's a bit of a dissonance there.
The one thing I did take away from Joe, though, is that when you hear Trump talk about maybe it's going to be more than 60% tariffs on China, I do want to potentially build a 10% tariff wall. Sure, maybe that's the direction of travel, but it sounds like from Joe that could be tempered. So it wouldn't be as extreme as potentially the former president is talking about in public if he's just trying to do a carrot and stick approach of trying to get a deal.
Does this tit for tat work both ways? For instance, do you think the United States is going to drop its tariffs on imported trucks? Do you think that's going to happen?
No.
So it's not going to work both ways?
Correct.
So the big tariffs the US has on importing stuff, that stays. But ultimately, if you have big tariffs on the United States, we're going to put ours up.
You know, and
Is that how this works?
Well, it doesn't work, essentially, because, and basically you're seeing that on both sides. So regardless of whether it's Trump or Biden, what Joe was saying there about what Trump wants to do is sort of similar to what Biden wants to do. He just is doing it somewhat differently. So, you know, honestly, at a certain point, how do you game that out to try to come up with some sort of projection for 2025?
Honestly, I'm being snarky. What I think is the bigger issue, I mean, shock horror, what I think is the bigger issue is just how much national security has crossed over into the realm of international trade. And it's the national security lever they're going to pull on a whole lot more. Up next in the next hour, Samara Cohen of BlackRock, Bloomberg's Josh Wingrove, Pierre Ferragu of New Street, and Constant Hunter of Macro Policy Perspectives. A lot to get through. Live from New York City, this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take
How
to
about
do?
the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Possibility of what people refer to as a no landing.
The risk of a no landing scenario, i.e. inflation staying high and growth staying high, that's really the tricky part for the Fed.
Right now, the risk is that they could make a mistake and they could cut too soon. Inflation could remain far stickier for longer.
How can the Fed cut when inflation expectations are continuing to march higher? It really is a major challenge for the Fed here.
I tend to agree with where the consensus is starting to go to. I think the Fed's going to have a hard time cutting rates the amount of times they want to.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg, and the Mag 7 continues to break down. Just check out the performance year to date. Here we are. There is absolutely nothing synchronized about this in any way, shape, or form. Apple, on the year, down 9%. Tesla down 24%. Google, -4%. On the year, Microsoft positive 10%. Amazon up 17%. Meta up 41%. NVIDIA up by 72%.
It's a question of who has the biggest AI exposure, who is the biggest AI darling, and then pump your money into that, because that basically has been what we've seen all year. Here's one of the angsts underpinning the market. At what point does this become something of a craze that has gotten over its skis, similar to what perhaps some of the electric vehicle hopes and dreams had? And that's sort of what we're seeing, potentially with Tesla, in addition to some other issues.
Is it froth or is it justified? Two very different views we'll be discussing this hour. JP Morgan's Marko Kolanovic saying signs of froth are building. David Kostin of Goldman basically saying the valuations are supported by fundamentals. So let's talk about the fundamentals of two names. I want to talk about Apple, I want to talk about Tesla, and China specifically, because deliveries for Tesla a struggle. And what we're seeing with China for Apple is arguably even worse over the last year.
Given the fact that in the first 6 weeks of the year, some independent data shows that its sales in China are down 24%. The key is this really because of a slowdown in the Chinese market? Is this because of a sort of de facto boycott in certain corners of Apple or U.S. products in China? Honestly, it's hard to pinpoint, but Apple already fell out of Goldman Sachs' wish list anyway.
If you're looking at patriotic buying, you can look at Huawei when it comes to Apple. You could choose a Huawei phone, which their sales are surging when it comes to smartphones. And then for Tesla's issue is BYD. But what I find so interesting is that Tesla and Apple are both either cutting prices, or Tesla last week in China is offering this insurance subsidy, but it's still not enough to get their sales up and ramping.
Yeah, let's draw a line between what's happening with smartphones and what's happening right now with EVs. EV is a struggle. EV is a struggle over in China because of competition. It's a struggle right here in the United States for a whole host of reasons. Adoption is just not increasing in the way that a lot of people hoped for just last year.
We already saw that with Ford and GM coming out and pulling back. You know, it's so hard to know whether people are just getting ahead of their, in terms of their excitement for things, and then to price that in. Because if you talk to the Ford CFO, he's going to say it will be an adoption cycle at some point. It just is a little bit faster, is a little bit slower than we expected. With respect to Tesla, they're a car company. That's the dirty secret. They've been wanting to be treated like a tech company, but now they're a car company. And that was sort of solidified by Apple saying, we're done.
Yeah, and maybe that requires a very different multiple. The stock was down 7% yesterday. It's down by another 1-point-something percentage points so far this morning. Equity futures on the S&P 500, negative by 0.25%. The bond market shaping up as follows. A big 2 days coming up for Chairman Powell. That's just around the corner later this week. Your yield on a 10-year down by 3 basis points, 4.1837. In foreign exchange, the euro a touch weaker, dollar stronger, 108.50 on that currency pair. Coming up this hour, Samara Cohen of BlackRock as Wall Street wonders if the stock rally is a boom or a bubble. Pierre Ferragu of New Street as Apple's China sales plunged 24%, and Constant Hunter of Macro Policy Perspectives as upside risk to inflation cast doubt over the rate cut timeline. We begin with our top story, boom or bubble. With stocks hitting all-time highs, Wall Street is divided. JP Morgan's Marko Kolanovic warning of froth in markets and writing, quote, earnings projections for 24 are coming down and the market appears complacent on the cycle. Goldman's David Kostin writing the following, this time is different. That's always dangerous. We believe the valuation of the Magnificent Seven is currently supported by their fundamentals. Samara Cohen, ETF and Index CIO of BlackRock, joins us now for more. Samara, wonderful to see you. We've got a lot to talk about in crypto and Bitcoin. I just want to get to the equity market first. Excellent. Boom or bubble, which one is it?
Look, I think the important thing is that one of the most transformed parts of markets today is participation of individual investors. So just to level set here, there are probably 100 million American investors who are self-directing their money. That's what we talk about. We say the self-directed investor. And about 30% of them are in iShares ETFs or in ETFs, right? So investors are participating in single stocks, but they're also participating in broad-based indexes. And I think that gets lost a little bit. Now, we can extend this story to China, which you were talking about before, where interestingly, we are seeing there are emerging market ETFs that are ex-China. that are seeing inflows, but there is also a lot of interesting options activity on China ETFs, which is one of the core ways that a U.S. investor can express a view on China. So what you're seeing there is actually bullish skew, probably 4 times as much call interest as put interest in getting a limited downside participation in China.
We hear the word trade versus investment. Trade versus investment. When they think about China, are they thinking trade and not investment?
Well, these are short-dated calls, so I think we're talking about short-term, limited downside participation and some upside. But so yes, I think what we are seeing is kind of the transition from, let's say, savers to traders to investors in the United States.
You talk about a lot of individual retail investors not going into a specific name, but trying to trade an index. How much are they essentially thinking they're trading some specific names, given the dominance of those names in the index? How much has that drawn in retail interest in a new way?
I think investors who want to trade an index are trading the index. It is incredibly easy. And you know, the reason we saw this real step up in participation over the pandemic that is now participated is that there is commission-free trading for, you know, all stocks, single stock or ETFs. There are much better experiences on digital platforms. And there's a lot of information, for better or for worse, coming through social media. So investors have the access to determine, do they want single stock exposure? Do they want index exposure? So I think the decision to allocate into ETFs or index product is very specific to the index outcome.
Even those people who already have allocated, I'm just wondering how you can gauge kind of the appetite for risk at a moment when there seems to be a lot already baked into valuations and people are getting concerned about some frothiness. Do you get the sense that retail investors are still gung-ho and they're still saying this is the time to start moving money out of cash and locking in longer-term yields, locking in some of the sort of prominence of artificial intelligence?
Absolutely. Well, it's artificial intelligence, but even upstream of that, I would say it's what does your fixed income allocation look like, of course, because last year was the year of cash. All of a sudden, a lot of these savers who were coming off the sidelines realized I have to do more than have my money sit in a bank account. I have opportunities in the cash market. Now the question is they have to start worrying about investment risk. Maybe they have a little bit more time than we thought before, given what we continue to learn from the Fed, but they have to think about their core fixed income allocations. And then to your point, they have to think about, and of course, this all depends on their time horizon. Where do they want their equity allocations to be on the risk spectrum?
They've got a new option, a spot Bitcoin ETF.
They do.
Can you just frame how big the inflows have been over the last few weeks?
Well, I think it's important to look at the inflows in the context of the category, right? So there haven't been ETFs on Bitcoin, and this is the first time ever we saw, ETFs enter an asset class. And at the beginning, the question was, do investors want to hold they have more options to participate in the Bitcoin market than they did before. But the inflows have definitely gotten attention.
Would you call it new money? That's what I'm trying to work out. Is it from the crypto universe just being put into the spot Bitcoin ETF because that's where people would prefer it to be? Or is it coming from elsewhere? Stuff that was previously invested in equities, in fixed income, that is coming to this market for the first time?
So I've seen lots of different analysis on this, and I would say the range between how much is new money kind of is between 50% and 75% that's new money, with the early days in particular being, recycling from other wrappers. And you can see that in the trading volumes as well. If I look across the Bitcoin trading complex, spot, futures, ETFs were probably about 15% of trading volume in those early days. Now it's leveled down to call it, 6 to 8%.
What do you see in terms of the sort of evolution of this year, where people are sort of shifting their investment strategies at a time where yields are higher but expected to come down, and there is this discussion about a rotation or something shifting in the equity space?
So number one, it is really determining what the appropriate fixed income allocation for them should be and where that is on the yield curve. And this is part of this bigger picture regime shift. How do you think about the portfolio? Now that we've had this, change in how we think about change in 40 years, where we have new investors who've never really had to consider inflation before. So that's number one. And then number two, as you said, is where do they go in their equity allocation?
There was a great piece on the Bloomberg talking about the return profile of cash versus actually investment grade and just government debt. And it actually shows that T-bills has outperformed over the past 10 years, or basically been in line. How do you shift mentalities that have been entrenched by that and say this time is different?
I think education plays an incredibly important role here. And that's one of the things that investors are looking to their advisors for, looking to media for, looking to digital platforms for. But there is just no question that that is probably one of the biggest risks to those, 100 million investors who are in the market right now. The biggest risks are probably, number one, the reinvestment risk if they're not, moving out onto the yield curve. And number two, the diversification risk, if they are looking to more volatile single stock or even crypto exposure.
Speaking of diversification, this is what I struggle with Bitcoin, and I'd love your answer to it. What are the characteristics of it in the context of a broader portfolio? What is it there for? What is it useful at? I mean, I understand the volatility, and I understand for people that want to play it, it makes a lot of sense with regards to that. But in the context of a broader portfolio, what characteristics does it offer me that I can't get from another asset class?
So I am going to answer that first with what you already know. Like, the number one characteristic that we do know is volatility. The number two thing that we know, and this is really what led to the SEC approving Bitcoin ETFs, is that investors are buying it. They want to be in it. We were hearing from advisors that they wanted another tool in the toolkit in order to let their clients who were calling them allocate to Bitcoin. But I think what we will be watching for the rest of the year and what will be really significant is what are the use cases in portfolio allocations. There's lots, well, I would say it's kind of an emerging body of research that's being written. But
we're still figuring it out.
That's the space to watch. There are some strong convictions, but I think when we start to see model allocations, including Bitcoin, and we should be very specific, we're talking about Bitcoin here, not any of the other crypto assets. I think that's going to be an important story for 2024 in the use of ETFs.
Is it uncorrelated risk? Is it for risk mitigation? What is it for? I'm still trying to figure that out too.
Well, I think that if you say uncorrelated, it seems to be pretty correlated to risk on appetite.
This year.
So, at what point is it actually uncorrelated versus just if you want sort of to feel cool?
Is that what it's for, to feel cool?
I mean, with your kids. Hey, kids, I've got a Bitcoin.
I wouldn't go that far. Bitcoin right now is negative. I mean, maybe. We're down by about 0.8% this morning. Samara, you're going to stick with us, I'm pleased to say. Samara Cohen of BlackRock sticking with us. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Target is gaining pre-market, up some 7.4%. Fourth quarter earnings beat estimates with better inventory management. Target has faced headwinds with fewer shoppers buying discretionary items thanks to higher inflation and interest rates. It also launched a membership program to rival Amazon Prime and Walmart Plus. China set an ambitious 5% economic growth target for this year, putting renewed pressure on the nation's top leaders to unleash more stimulus to lift confidence in an economy hit by a property slump and entrenched deflation. Analysts surveyed by Bloomberg forecast the economy will expand by 4.6% in 2024. Counterpoint Research says iPhone sales in China fell 24% in the first 6 weeks of the year. To stimulate demand, Apple had offered a rare discount on its website in January. Apple fell 16% of market share from 19% a year ago, according to the researchers. Apple has fallen 9% since the start of the year and lost the title of the world's most valuable company to Microsoft. That's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, on course for a rematch in November.
It is Super Tuesday, but this really is more of a stress test for the general election between former President Trump and current President Biden. I think this nomination will be wrapped up in about 2 weeks.
Trump-Biden, Volume 2. That conversation up next, live from New York City this morning. Good morning.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Stocks on the S&P 500 negative here by 0.2%. It's a subtle pullback on the S&P 500. Yield to lower by 3 basis points, 418.57 on a 10-year. Under surveillance this morning, on course for a rematch in November.
It is Super Tuesday, but this really is more of a stress test for the general election between former President Trump and current President Biden. I think this nomination will be wrapped up in about 2 weeks. Nikki Haley, again, she's looking to get the prize without the winning, but it's quite possible that her voters are the ones that can unlock a general election win for either Trump or possibly Joe Biden.
Here's the latest today. Donald Trump and Nikki Haley going head-to-head across 15 GOP primaries. Trump expected to tighten his grip on the Republican nomination, moving closer to a rematch with President Biden in November. Joining us to discuss is Bloomberg's Josh Wingrove. Josh, out of those 15 GOP primaries, can Nikki Haley win one?
Well, she won the D.C. primary, John. We don't talk about that, you know, big one here. I think expectations are pretty low. But that being said, one of the big questions, of course, is whether Nikki Haley is going to drop out. You know, I think our guest there that you played the clip of said that this could be wrapped up in a couple of weeks. I think it's wrapped up now, essentially. Donald Trump, for all intents and purposes, is going to be the nominee. The party's acting like he's the nominee. Joe Biden, of course, is going to be his party's nominee, barring some sort of shock surprise. And so this is where we're at, and this is where we're going. I think one thing that's been interesting to watch is even in these races where Donald Trump has cruised to big victories over Nikki Haley, he's actually underperforming his polls. He's not beating her by as much as the polls indicate. So I'll be watching for that tonight. Is there continued sort of polling error that overstates Trump's support in this primary? That, of course, is what the Biden people are hoping for, because all the polls right now, including the Bloomberg Morning Consult poll, show Trump leading Biden. And if the polls are overstating his race against Haley, you might wonder whether they're overstating the race against Biden. As for Biden, what we're watching for today is whether he has more of that protest vote factor in states like North Carolina. We saw this in Michigan, where the uncommitted vote was encouraged for Arab American voters, Muslim American voters, progressives who are upset about the situation in Gaza. So that's sort of the undercurrent on both of them. But broadly speaking, it'll be a good night for Joe Biden. It'll be a good night for Donald Trump. And this is the starting gun to the 2024 race.
Well, Josh, for the undercurrent for Trump, it looks like he has a steep hill to climb when it comes to general election, given, even though she's losing, the percentage of votes Nikki Haley is still getting in some of these primaries. You were at the White House yesterday with Mark Cuban. You were tweeting about it. And you asked him, and he cast a ballot in the Texas primary for Nikki Haley. But he said when it comes to the general, he's going to back Biden over the former president. How many of people are like that in the United States that Trump is going to have a difficult time picking up?
This is the million-dollar question, Anne-Marie. I think we should be asking every Nikki Haley voter walking out of that primary, hey, what are you going to do in November? Because not only are they voting for her, but demographically, Haley's voters look nothing like Trump's voters. And so the question, they frankly look a lot more like the coalition Biden put together. So the question is, do these people stay home? Do they hold their nose and vote for Donald Trump? Do they hold their nose and vote for Joe Biden? We just don't know right now. And I think that is just such a key factor. Cuban told me that his vote for Haley was explicitly a, quote, protest vote against Donald Trump. And not only did he say he'd vote for Joe Biden, he waved off some of the age concerns. He said, if they were giving Biden his last rites, I would still vote for him over Donald Trump.
Wow, that's something. So Thursday, we're going to get a sense of how the president is doing and the policies he'd like to enact if he got 4 more years. What are you looking for the State of the Union?
Yeah, I think this is where, Biden's sort of big campaign kickoff speech, for lack of a better phrase. We're going to hear a lot about costs. We're going to hear a lot about stuff that you and I, who've been watching this, have heard before, but they kind of struggled to get the message out. They passed an infrastructure bill. Not really a lot of people know about it. They passed a CHIPS bill. Not really a lot of people know about it. By the way, we're going to hear billions of announcements over the next months, I imagine, on that CHIPS bill, on infrastructure. So brace yourselves for that. They'll be rolling out a lot of stuff on that. He wants to basically give the theory of the case that they are governing, essentially, and that he deserves another term for governing. Of course, what our poll showed, 82% of voters think Biden is too old, or that both Biden and Trump are too old. A lot of the question on Thursday will be on his delivery. Can he quell concerns, including concerns within his party, not just with Republicans, about his age, and sort of rally the troops? And of course, on Monday, we're expecting the federal budget, Biden's budget, to be
from the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I want it to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Some of their accomplishments. I think it actually is a pretty deep point, because the question is, do they have a cohesive message that caters to all sides of the party and the sort of populace that they want to trot out? Or don't they? Is that part of the problem and the reason why you're not touting some accomplishments, whether it's, lowering gas prices, which they say, but how do they do that? Or if it's something like some of the fiscal spending that's contributing to the deficit, but also has supported the economy.
Samara, I wanted a final word from you on the politics. Forgive me. I keep doing this every single day. I turn to the guest on markets this night. Forgive me. We've got to talk about politics. What are you advocating for ahead of November? Just ignore it for now? What are you telling people?
Look, what we know is that 4 out of 5 Americans are worried about their financial well-being in retirement. So whoever wins, we know a couple of things are really important. Number one, monetary policy is independent. That's intentional. Investors have to figure out their fixed income allocations, particularly with Fed easing on the horizon. And number two, equity markets will reshape to accommodate the demands of increased participation of individual investors, whether that is in crypto, whether that is in single stocks, and that is going to be, and needs to be a priority of either administration. And that individual investor participation has risen over both Trump and Biden administrations measurably.
Is that another way of saying stocks will go up, regardless of who's in the White House?
Historically, when the economy grows, stocks go up, and that has been true generally in election years, and that would be a good thing for the increasing participation of individual investors.
Samara, it was great to catch up with you.
Thanks for having me.
Samara Cohen of BlackRock. Stocks go up. I would go back to Japan and the conversation we had earlier this week. We've been conditioned in America that stocks only go up. You do get lost decades. You get lost decades in Japan, lost decades in certain markets in Hong Kong, and certain markets in Europe. Even in certain markets in tech in America, we had basically a lost decade. For a long, long time, we had more than that. So, Bramo, these things can happen.
And the reason that people care about this is the why behind it. Is it a demographic issue, as it was partly in Japan? Is it also some of the investment or lack of it? I wonder for the U.S., is it also the deficit issues? If you start to see yields rise really considerably, what that does to certain asset valuations and some of the growth projections going forward.
One thing that is assured is deficits and a bigger debt pile and more bond supply, right?
I just
think we can agree on that.
I just wonder, are we going to have a Liz Truss moment? I mean, really, I just wonder if we're going to have something like that, you know, where basically the bond markets are like, absolutely not. Take that back.
I'm not sure the Treasury market wants a Liz Truss moment.
No.
I think a Liz Truss moment caused some chaos in global markets for like 5 minutes. I'm not sure a Liz Truss moment in Treasury markets would be shaken off quite so well.
No, it would be intense.
2-year yields are lower by 2 basis points. This right now is not a Liz Truss moment. 458 on a 2-year. Coming up next, Apple sales in China falling 24%, according to data from Counterpoint. That conversation with Pierre Ferragu of New Street up next.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Two-day winning streak on the S&P 500 snapped yesterday, down a little bit lower this morning. We're down 0.25% on the S&P, down 0.5% on the Nasdaq 100. There are some single-name stories we need to talk about. Tesla, Apple. We'll do that in a moment. In the bond market, 2-year, 10-year, 30-year, Bramo has a new warning. Liz Truss moment stateside. Maybe, possibly, later this year.
Totally. That's on my list of worries. Could be. Not later this year. Actually, that's not true. If it depends on what we get. If we get some sort of package that talks about increasing the deficit dramatically, and no one's looking for that, and you have inflation, well, let's see.
That's the point. Context matters. What does the growth backdrop look like? What does the inflation backdrop look like? If we do have reinflation risk and that materializes by the end of the year, if you do have robust growth in America and yields are somewhere close to 5%. So that's a lot of ifs, but if all that lines up, and then you have a president come into power that says, guess what, going to push even harder here, go even harder on growth, domestic growth, and we're going to put up the barriers to importing that deflation from China, then you've got potentially that kind of pushback. But this goes back to a question I've asked. Does Washington still have the privilege of behaving recklessly? Do you believe they do? Because Liz Truss in the gilt market is not the president of the United States in the Treasury market. That is a very, very different thing.
For now. I mean, I'm just saying, correct. The US
Granted.
and UK are completely different in many, many ways. That said, I have been thinking a lot about this, because if you get the recipe you're talking about, and then you get someone who comes in and has a much more protectionist policy, which is both inflationary and possibly negative for growth, that's the problem at a time where there are people on the periphery saying, it's starting to matter a little bit more that we have this kind of deficit.
I think that would be the definition of running things hot, just a little bit. It's like putting the microwave on and turning the US economy up. Equity futures then slightly negative in the FX market. We are negative by 0.1% on the euro. The euro coming down to about 108.48. Under surveillance this morning, we've got to talk about Bitcoin. The price of Bitcoin nearing an all-time high as demand for new ETFs using a cryptocurrency, as well as a looming reduction in supply growth, drives gains. Bitcoin's price surging nearly 160% in the past 6 months, taking its market cap to a record 1.35 trillion US dollars. That spot Bitcoin ETF was not a Southern News moment.
No, which is sort of surprising, and it raises this question of why. Is this basically institutions that are rallying to the asset class? Is this individuals coming back in? It doesn't feel the same kind of, to have the same kind of frothiness that it has in the past, where everybody was going into Dogecoin and meme coins and everything else, but kind of it is. There sort of is this sort of NFT feeling as well that's happening on the periphery.
You heard it from BlackRock. Institutional adoption is part of this, but I was trying to work out how much of this is new money. Is this a new wrapper and people are just taking the money from elsewhere within the crypto universe and placing it in a BlackRock ETF? Or is it truly new money coming from other asset classes, coming from cash on the sidelines? Got a pretty strong suggestion it was more of the latter than the former.
Especially because we even heard this from investors who came on here who said that that was their diversifier, perhaps even better than bonds, because it isn't sort of subject to the higher potential rates due to inflation. I just wonder, diversify from what? You raised that, which again, it's a risk-on asset class. When does Bitcoin rally when everything else is in a negative
That's
place?
what I was surprised at from BlackRock. What is the place of Bitcoin in the context of a broader portfolio? What are the characteristics that I'm getting from that asset class that I'm not getting from elsewhere? And the answer was kind of like, we're finding out. We don't really know.
Yeah, and that's basically what we hear from a lot of people, except for some of the people where it's sort of a religious feeling of, you know, this idea of what gets replaced in terms of the modern way of money. And I don't know that we really have gotten that in a full-scale adoption, but you feel that energy sometimes.
That energy, is that what you're calling it? You're saying that religious-type energy?
Yeah, like the followers. It's very much a religious... anyway, move on.
Bitcoin is down by 0.7%. Are you like imagining the hate mail you're about to get in the next few minutes?
Stop knowing me so well. Just move on.
Forward all emails to TK. Just forward all emails to TK.
I'm all for it. I'm all for financial innovation. I'm all for trying to understand this. I just wonder if you have this digital gold moment.
You're describing a cult almost.
Well, I'm just saying that there are people who really
tell
believe
me,
it.
just, you know, they're there, just down the barrel of the camera.
I think that I want to learn more about it, and I want to understand if we can get a full adoption. I also think that it does raise questions about cross-border kinds of transfers of payments, and that I think is really interesting.
Good save, nice. Let's turn to Target. Shares jumping in the pre-market after fourth quarter earnings topped estimates. The retail giant reducing its inventory by about 12%, limiting the amount of risk associated with markdowns in-store, and digital traffic declined for a third consecutive quarter, but at a slower and narrower pace than analyst expectations. Target also confirming it will launch its own membership program, going up against rival efforts such as Amazon Prime and Walmart Plus. That stock is flying in the pre-market, high here by almost 8%.
Yeah, and basically they're turning it around, right? They had seen this sort of slow decline of growth, and they're pointing to a sense that maybe they'll have some sort of growth. To me, what I find interesting is the new model of these stores. It's having a loyalty program. It's having some sort of shipping apparatus that they're going to have in the back rooms. And it's beauty products. I mean, honestly, that's the only one piece of it, but really the Ulta Beauty. I find that really interesting.
There's some big difficulties last year
Yeah.
around Pride Month, and they're moving on. But that was a real lesson for the business world
We saw
almost
with-
12 months ago, you know.
You know, we saw that with Budweiser too, and AB InBev actually turned it around too.
Yeah.
So it was a blip, but that's the reason why you're seeing this real
I
pushback
understand
against a lot of this stuff.
conservatives are giving Bud Light a second chance, giving them a second chance.
Would you like to say something about that?
No, give them a second chance. We're all on board. I don't even drink Bud Light.
You don't drink alcohol.
Sales of Apple's iPhones in China falling 24% during the first 6 weeks of the year, according to data from Counterpoint Research, is the latest blow for Apple in the world's biggest smartphone market, with local rival Huawei seeing sales surge 64% in the same period. Apple introduced rare discounts on some devices earlier this year to stimulate demand, while online sellers cut prices by as much as $180. For more, Pierre Ferragut of New Street Research joins us now. Neutral rating on Apple with a price target of $175. Pierre, wonderful to catch up with you because you are perfectly positioned to talk about these two stories. These two names, Apple, Tesla, both fall under your coverage. Pierre, can you tell us whether there's any crossover in the challenges that those two names are facing in two very different industries in China?
Thanks, John. Yes, if you look at Apple, really it's a competition, it's mostly a competition issue. The overall smartphone market in China is weak, down 7%. You know, over 2 months, it's not like a massively significant data point. We'll have to wait to see how things evolve beyond February and the Chinese New Year. The big piece of news is that Huawei now is on a run rate of selling 3 million units a month, roughly, and they were selling like barely 2 million units a month a year ago. So Huawei is back in China. They were not able to do phones for quite a while because they couldn't access chips manufactured at TSMC anymore. Now they figured out a way to do chips domestically on mainland China. They are back, and Chinese consumers like to buy Huawei phones. Remember 2021. The iPhone 12, we were expecting a very weak cycle. We were expecting Apple units to come down from 235 million units to 200 million, if not lower. It did not happen. In 2021, Huawei disappeared from the map. Apple benefited a lot in China. This is now coming back. Huawei is coming back, and Apple is probably going to lose significant share in China this year. That's really what's happening for them.
Pierre, we've been identifying 3 separate themes. One is just overall Chinese growth. The other is the competition you've just spoken to. The third piece, I think, is really difficult to break out, and I wonder how you get a read on this. Rising consumer nationalism in China, in the mainland. How do you break that out, Pierre? How do you identify some of that?
Yeah, I think that was on the table in 2021 as well. At the time, remember, Huawei was doing very well, and there was a feeling that the Chinese consumer was pushing back on US products and on the iPhone. I think we need to wait 6 more months to get a feel for that. Is Huawei coming back to where they were in 2020 or early 2021, or do they continue to gain share against Apple? This is going to be our answer. Because remember that without Huawei, the Chinese market doesn't really have an alternative in the high end to Apple, like a Chinese alternative. So we need to have Huawei in the game and see if we see sustained share gain. Then that would be a sign that nationalism is at play.
Something that both Apple and Tesla have done is cut prices. Do you think we could see more of that?
So really, the cutting prices is a big theme in the auto industry. The difficulties there are more like market-wide and structural. All EV makers have had to lower their prices a lot in order to maintain demand. We've seen a game of market share moving back and forth between BYD and Tesla. In the first 2 months of the year, quite surprisingly, something that the market didn't catch well, Tesla actually did much better than BYD and regained share against BYD. But overall, in a market that remains very slow, very weak, and so you continue to see price cuts, but most of them are behind us. If you look at how Tesla is cutting prices today, they're like lowering prices on an insurance product, or they're cutting prices on like an option, like a different color, thing like that, which means that the base price is not moving anymore, which is a positive. So on balance, Tesla, first 2 months of the year, doing better than BYD, no core price cuts anymore. I think Tesla is more or less finding a floor in China and in a place where they can maintain the kind of volumes they've been selling in the country in recent months.
There's a larger question, Pierre, and I'd love it if you could address it, about whether the big tech frenzy that we're seeing in the United States is going to be dampened or is vulnerable to a reality check in China, a reality check when it comes to demand, a reality check when it comes to being able to sell, when it comes to AMD, for example, creating a special chip just for China, and then the US government saying that's not good enough. At what point are some of these risks accurately priced throughout the entire Magnificent Seven complex?
It's a great question, and I think it's really on a name-by-name basis that you get an answer to that, and you need to dig quite deep into the numbers to get a sense for it. So for Apple, for instance, we think that if Huawei really comes back to where they were in 2020 and early 2021, there is downside to expectations for Apple this year, maybe like a further 10 million unit cut or 5% of volumes. So there is a bit of downside, and it's a headwind on stocks. On the chip side, most players have been very cautious. I don't know specifically for AMD. I'm trying to speak to them today to figure it out. But most players have been very cautious, not taking into account China into their guide. And remember that today, chip is gold. There is a chip rush. Everybody wants to buy more chips. So anything you don't sell in China today in the chip market, you're going to sell it elsewhere. So I wouldn't be too worried. You take a step back and you take a broader picture, and on a longer term horizon, China is more or less 20% of like the tech ecosystem when it comes to end market and domestic end market. And that 20% is coming down for sure. Like it's going to get more and more difficult to sell Western technology into China because you'll have regulatory constraints, and also because China wants to grow more independent. But I think it's a 10, 15, 20-year process to see this silicon curtain growing between China and the rest of the world in terms of technology. And that's a headwind that is here to stay for sure.
So just to encapsulate it, it sounds like maybe Apple and Tesla haven't fully priced in, or at least that seems to be the appearance in today's market, the risk from China. The other stocks are more insulated because they already have not been necessarily pricing in any kind of benefit from China. Is that kind of what I'm hearing from you?
Yes, exactly. Especially in the semiconductor side of things and the semiconductor value chain. Yes.
Hey Pierre, this was great. Just wanted to get your perspective on such an important story. For a number of names this morning, Pierre Farragut there of New Street. This is way more nuanced, obviously, from company to company, from industry to industry.
And that's what we're hearing about, and that's the reason why you say, what's the linkage even between Tesla and Apple, considering they're two different industries with very different dynamics. That said, there clearly is a sea change, both with respect to demand in China, and that's been going on for years, but also with respect to just the willingness to buy U.S.-made products.
Big time. Both those names are down in the pre-market this morning. Let's get you an update on stories elsewhere today. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. NYCB is higher pre-market after another plunge and more downgrades. Shares of the company dropped to a 1996 low, falling 43% in 2 days. Fitch cut its rating, and Moody's lowered theirs again after already having the bank at junk. NYCB has lost more than 2/3 of its value this year. Elon Musk has lost his position at the top of the Bloomberg Billionaires Index. Tesla tumbled 7.2% yesterday. Jeff Bezos is back at the top with more than $200 billion versus Musk's $198 billion. The wealth gap between the pair was once $142 billion, but it's been shrinking, with Amazon shares doubling since 2022, and Tesla with it down 50% from its 21 peak. The International Space Station has 4 new residents after the successful docking of SpaceX Dragon spacecraft. 3 NASA astronauts and 1 Russian cosmonaut will oversee the arrival of 2 new rocket ships during their 6-month stay. Boeing's new Starliner capsule with test pilots is due to arrive in late April. Sierra Space Dream Chaser mini shuttle is due a month or 2 later. That's your Bloomberg Brief. John.
Very cool. Danny, thank you. Up next on the program, upside risk to inflation, muddying the path to rate cuts.
How can the Fed cut when inflation expectations are continuing to march higher? It really is a major challenge for the Fed here, where you both have a tailwind as a result of their own actions, but also with the market now saying that inflation expectations are continuously drifting higher.
Torsten Slock of Apollo, so punchy about this. No rate cuts in 2024. We'll discuss that call next on the program. Live from New York, this is Bloomberg.
Trends in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Why should somebody want to be in the pharmaceutical industry? Why not go into something sexy like private equity?
In the end, what we do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley.
Lisa getting so much love right now. How's that going, Bramo?
You could come back to me next year.
Okay, you let us know. We work through those emails. Equity futures on the S&P. I told you, just forward them to TK.
Okay,
all right?
great.
What does he call Bitcoin? BitDog.
Yeah, well, I mean, okay.
Just
but
let him take it.
Yeah, but I don't want to be like correlated with that. You
don't
know,
be correlated with Tom.
No, in terms of sort of like
equities are down.
His dismissal of the whole asset class.
Okay, TK, if you're listening, we're down about 1/3 of 1% on the S&P. Under surveillance this morning. Upside risk to inflation, muddying the path to rate cuts.
We need then financial conditions to begin to tighten. And given that's not happening every day, including today, you're seeing more and more signs of easing. How can the Fed cut when inflation expectations are continuing to march higher? It really is a major challenge for the Fed here, where you both have a tailwind as a result of their own actions, but also with the market now saying that inflation expectations are continuously drifting higher.
Here's the latest today. The Fed's Raphael Bostic warning of, quote, pent-up exuberance, posing an upside risk to inflation if the Fed cuts too quickly. Constant Hunter, macro policy perspectives, not sharing those concerns, writing this. A series of cuts in June or July will likely allow the economy to capitalize on the productivity surge underway and could allow for a repeat of the second half of the 1990s, where growth accelerated and the price level declined. Constance with us around the table here in New York. Constance, good morning.
Good morning.
Why is Thorsten's Block of Apollo wrong in your opinion?
Well, I think there's a few things. When you have a productivity surge like we are having right now, you can have the economy continue to be fairly strong while inflation continues to moderate. So Laura Rosner on our team, who is an inflation guru, has a forecast that we'll have in hand for the Fed by June a 2.1% year-over-year handle on PCE. So they will have data that could allow them to cut. And then you have to ask the question about where should real rates be? Now, of course, this is, we don't know the full answer to this, but let's say they were to cut their 75 basis points this year. You go from very restrictive to still moderately restrictive. And so you still have restrictive rates within the economy. I also think that, the financial conditions that we all look at on Wall Street are not necessarily the financial conditions that the average consumer faces, right? So the average consumer is dealing with, higher interest rates on credit cards, higher interest rates on auto loans, inability or home mortgages being so high that they're priced out of purchasing a home. So yes, if you own stocks, financial conditions are easier. If you don't, and you're younger or you're not in that demographic, you still have pretty tight financial conditions.
So you're downplaying the contribution from equity markets at all-time highs, credit markets being super loose just in terms of the ability to come to market, issue debt, and that debt's being brought. Is that not that important to the reacceleration we've seen in the economy over the last 6 months?
So we don't think that that reacceleration is going to continue apace in the first half of this year.
What do you think fueled it? What underpinned it, in your opinion?
Well, there were a number of things. I mean, you had an inventory buildup, but you also had productivity, right? Like productivity surged in the third quarter. It continued to grow strongly in the fourth quarter. We think that there is a lot underpinning this productivity story. So aside from the obvious, right, AI, and I'm not even talking about generative AI, just basic AI, large language models, firms are still implementing those because if you're a large firm and you have legacy IT, you have a number of different programs. So first you need to downsize and right-size all of the different apps and different programs you're running so the data can talk to each other before you can even harness the power of AI, right? So that process has been underway, and now firms are beginning to use just basic AI to help improve their operations.
So one of the challenges right now, a lot of people, sorry.
It's okay.
I'll let you finish in a minute, but one of the things that people are saying is that all of these things are getting baked in terms of AI and the productivity gains. Are we misplacing when this story comes to fruition, given the fact that the data still seems to suggest quite a bit of inflation, and the data still seems to suggest that things are maybe heating up more than they are cooling down?
So let's unpack that, right? What parts of the data are showing really high prices? So we know that, for example, what's been happening in vehicle prices has been coming through into CPI with a lag, right? And so we expect those prices to begin moderating. Insurance prices have been high. So whether it's homeowners insurance or auto insurance is one of the things that has risen the most since the beginning of the pandemic and continued to go up, last year and in the recent print, right? So that we expect not to continue going up at the same pace. Insurers took this opportunity to get market pricing power. They're not going to be able to continue doing that at the same pace. And then, of course, there's that big OER component and what happened with the reweighting and how rents are going to play through. And so we do see market rents are coming down and are actually negative year over year. All that's going to play through over the next 6 months.
There's disinflation and then there's weakness. Is there a real risk right now, if the Fed doesn't cut rates for a bit longer, to wait to see some of the data that you're talking about come into play?
Oh, I am not. I think that it pays for them to be cautious on so many different levels, right? That's their job. They need to be measured. They need to be careful. And because you have this productivity, it gives them extra policy space, right? They can wait a little longer because the economy is strong enough. One of the things that we are looking at very closely is what's happening in the labor market, of course. And for this Friday's report, one of the things we're going to be looking at is really what's happening with hours worked, right? How much of January was weather? It seems like it was more than weather. And we do web scraping of company earnings. And what we see both in the data and the comments is that firms are actually using hours to continue with labor hoarding, right? They don't want to lay people off, but they don't have as much work for them to do. And so, and when I talk to some of our clients, like some of our clients are mid-sized banks, and they say that like when they speak to their clients, there's weakness out there. So firms that aren't coming to the market to issue debt, firms that have to rely on banks and other credit sources are not seeing easy credit conditions.
You write in your note, under the hood, you have concerns of the labor market. So is that what it is? They're not laying off people, but they're restricting them so much to basically the least amount of hours they could work to keep them on?
Yes, exactly. And so they're saying we don't want to let people go, but what that means, of course, is less weekly or hourly earnings, or less weekly earnings in people's pockets, right? So you saw earnings go down, actual earnings go down in January because hours worked fell.
Looking for hours worked to climb, maybe on Friday, the estimate in our survey.
Not necessarily.
I'm going for our estimate first. You can jump in a second. 34.3, previous number 34.1. What are you looking for?
So we're looking for them to stay about the same, and we're hoping that they actually come up a little bit because then that would confirm that there was some weather effect in January, which certainly we had a lot of weather happening. But if they decline in line with this survey, then it would suggest that this labor hoarding story has shifted to a new phase where in order to continue labor hoarding, firms have to reduce hours.
Interesting. Constant, good to see you. Thanks for being here in New York. Constant Hunter there of Macro Policy Perspectives. The other numbers in our survey, sneak peek of that for you. going into Friday. 200K is the estimate in our survey at the moment. That's the median estimate. Of course, you'll all remember the previous number was a blowout 353,000 that none of us were looking for, Bramo.
I'm curious to see the revisions. I want to understand just how
If
things...
353 is really
Exactly.
353.
I mean, because how much have we seen the revisions downward afterwards, that revised downward by about 100,000 jobs? I mean, how much are we going to see that kind of revision and everyone's going to trade off the revisions?
I said at the start of the week, it's a long road to 8:31 Eastern Time on Friday. Got a lot to get through this week, including a double dose of Chairman Powell as well, and a State of the Union address on Thursday evening. Coming up for the next hour, to look ahead to all of that, Elise Ossenbar of JP Morgan, Rick Davis of Stone Court Capital, Lauren Goodwin of New York Life Investments, and Tom Narayan of RBC Capital Markets. A lot to talk about in this market, and some single names as well, with Tesla and Apple down in the pre-market. Equity futures on the S&P 500 negative here by 1/3%. As we head towards some economic data a little bit later this morning, a few hours away, it's the ISM Services Index. Going into it, the bond market, bid. Yields are lower by 3 basis points. The 10-year 4.1837. On a 2-year down 2 basis points to 4.58. The third hour of Bloomberg Surveillance up next.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
Jobs Day, and Bloomberg has the report under surveillance.
We've had unemployment sat at 4% for 2 consecutive years.
This is a two-sided sword.
There is a softening in labor demand.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is a very strong labor market.
The White House has got to love this.
This is something huge they want to run on.
Where is the slowdown?
If you look at the reality, it ain't showing that.
The February Jobs Report, Friday on Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
we are starting to approach a little bit of euphoria here.
The tailwind that's coming from easy financial conditions is really not surprising.
There's a begrudging acceptance in the investment community that this economy is really not nearly as fragile as people think.
The economy, because of AI and technology, might keep on growing. That's the biggest, actually, potential market surprise.
Maybe, just maybe, we could have stronger job growth with inflation coming down.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. The third hour begins right now. And in many ways, the week begins in a couple of hours from now, 10 a.m. Eastern Time, when we get the ISM Services Index. That's going to start really the big run of economic data that you get through the week, which climaxes and concludes with payrolls on Friday. ISM Services, do we get a pick up there, Bramo, going into Chairman Powell tomorrow?
I would argue that actually could be the most market-moving aspect of today, given the fact that we did see that expansion last month. We did see a higher-than-expected increase in prices paid. Do we continue to see that at a time where everyone's banking on Goldilocks and disinflation, even with strong growth? Do we get that? And will this be a reality check?
My favorite line so far this week was from Kit Jukes of SocGen, who said the US dollar was feeding on a diet rich in US exceptionalism. Really, just to frame that, think about the economic data we're looking for Friday, 200K on payrolls, 3.7% on unemployment. China puts out a 5% GDP growth target, and everyone's like, can you hit it? Can you hit it? And there's some big doubts about whether they can.
And part of the reason why is because they don't want to borrow more money, and they want to continue with their deleveraging. So if they want to continue deleveraging, where are they going to pay for this? That's a serious issue. And the fact that they're not giving any kind of conclusive ideas to that has left everyone kind of, I don't know, lacking.
And that market is the reason that Apple is down this morning by 2%. That market is the reason why Tesla got absolutely hammered in yesterday's session, and that weakness continues through to today as well.
Well, Premier Lee said it himself. It's not easy for us to realize these targets as they put out these targets. That's why everyone is shrugging all of this off. When it comes to Tesla and Apple, they're dealing with growth issues when it comes to both the EV market and the smartphone market in China. And then we keep coming back to this idea. Is it growth versus is it this idea of patriotic buying? Why would you buy a Tesla in China potentially if you maybe could buy a BYD at a cheaper price point and also raise the Chinese Communist Party flag? Same with Apple. They're cutting prices, but Huawei's doing pretty well with their new phone.
So I woke up this morning and I thought, okay, the list of worries, is there anything new to put on it, right? And Nouriel Roubini basically blew it out of the water.
Let's just top of the pile.
Nouriel Roubini being a bull. You know, there's some other concerns that I have as well, but this is a new one. Is the China risk not adequately priced into the big tech bet, right? I mean, that's sort of one key question. Is it really just specific names that could potentially be affected, or is there some sort of broader story here that hasn't been fully factored in? I think it can sit there on the bottom, just sort of hanging out.
4 US companies, not 4 Chinese companies listed in China, because arguably we've seen that priced into Chinese equities. They've had a dreadful time until recently. They've had a really tough time. Does it go the other way? This is something that I struggled with for years. I thought for a long time that the Chinese consumer would just tolerate what was happening and would carry on buying Western companies. They'd want your Ralph MHs, they'd want your foreign autos. I'm just wondering whether we're really seeing in the last couple of years something much bigger. And if we do get a President Donald Trump, and he goes even harder on tariffs, it's the tit for tat, not from the government, from the consumer, that is far more interesting.
Especially considering the fact that the more there is sort of rhetoric around this, the more you see Chinese consumers actually voting with their feet, voting with their pocketbooks. But you get all of the different factors, AMD not being able to sell certain chips in China, while you do have a sort of nationalist feeling among the Chinese consumer. Is this priced in at a time when basically the U.S. is being treated as a bastion of exceptionalism, as you were just talking about?
It's tough to be a multinational in this world right now. Do you know what was really revealing? BNP Paribas, the way they responded to that growth target in China, they viewed the target as a tool to boost confidence domestically, to tell the consumer, to tell the people of China that this was the growth target we were shooting for, this lofty goal, and that in and of itself was going to help us hit it, because that would boost confidence.
Okay, this is sort of like, you know, if youth unemployment is too low, just don't report it. If you don't really have a message that you want to tell, don't give a press conference. Does that work? I don't know. Let's check back in 6 months.
Yeah, I'm not sure that's going to boost animal spirits in any way, shape or form, but we shall see. Equities right now on the S&P 500, negative by 1/3 on the S&P, and the bond market shaping up as follows. Yields have been lower throughout much of this morning. We're down this morning by another 3 basis points to 417.79. In foreign exchange, the euro 108.49. Coming up this hour, JP Morgan's Elise Ossenbaugh on growth expectations beyond the Mag 7. Stone Court Capital's Rick Davis on Nikki Haley's future as voters head to the polls for Super Tuesday. And Lauren Goodwin of New York Life Investments looking ahead to the payrolls report on Friday. We begin with our top story, the performance of Tesla and Apple casting a shadow over a stock market sitting close to all-time highs. JP Morgan's Elise Ossenbaugh saying this: the economic backdrop remains healthy, supporting a case for patience, and earnings keep surprising to the upside. We think most of the Mag 7 will continue to deliver strong growth, but we're looking for the growth to broaden out. Elise, I'm pleased to say, is with us here in New York. Elise, good morning to you.
Good morning.
I went back over your old calls at the end of last year. They've held up really quite well. Can you go through them and just walk us through what you were looking for and why ultimately you've been right?
Sure. So I think we started embracing the optimism at the right time. What we began to realize about 6 months ago is that the U.S. economy is much more resilient to higher interest rates than we initially thought, maybe at the onset of 2023. And now we're at this stage where potential growth is starting to inflect higher, largely underpinned by labor market dynamics. You've seen that supply side of the labor market improve, really driven by things like foreign-born workers and also women's labor force participation. And so all of the ingredients are kind of there for a sustained expansion of the U.S. economy, and that is what underpins our conviction in earnings growth for 2020.
And it wasn't rate cuts. That's what's interesting about this. So I was going back over an old note of yours, that you were waiting for a further loosening in the labour market before being fully confident of imminent rate cuts. That wasn't the position of a lot of people coming into 2024. Are you seeing any sign whatsoever that we're seeing deterioration in the labour market?
Not yet. I mean, we just had that January payrolls report that came in really hot. We'll see what Friday, ends up having in store for us. But again, it's that supply side of the equation that I think is really helping ease some of that tightness in the labor market. And we did just shift our rate cut expectations. We came into this year calling for 5. Now we're right about 3. But that doesn't derail this optimistic equity outlook that we have, because it's really the earnings that we expect to do the heavy lifting. And we think the multiple can stay, right around where it is by year end.
So far, the earnings really have been consolidated in the Magnificent 7, or I guess now we can call them the Magnificent 6 or 5. And I'm wondering, where you see this broadening out to come from, since some of the smaller companies that are more consumer facing are arguably also the more interest rate sensitive ones that will struggle more if rates are held higher for longer.
Absolutely. We are not saying that dispersion in the market's going to go away. To your point, the Magnificent 7 did the bulk of the heavy lifting to eke out that positive gain in S&P 500 earnings growth for full year 2023. But going forward, we think the remaining 493 names in the index can ultimately muster about 8% earnings growth this year. And we're focused on themes like AI. Hype there is very real. Industrials, given the policy tailwinds, and also, healthcare innovation and different dynamics that we're seeing amongst the consumer cohort.
So I want to ask you my worry of the day, which is how much are we underpricing the risk of the China aspect, the China factor to some of the tech companies in the U.S. that do have Chinese businesses, that do have to, deal with their footprint currently, or is this just an Apple and Tesla story?
It might be a company-specific story, and I think markets are really level-headed in how we're digesting this. You're seeing that price action. Even within the Magnificent 7, there is this dispersion, but other companies like Microsoft, AMD, NVIDIA, et cetera, their earnings stories are really underpinned by real results. Some of that's being driven domestically, but this is also really a global phenomenon that we don't expect to go away.
You mentioned some of the other 493 stocks and the AI hype being real. Is it AI hype or is it AI reality? Does it matter? Or is it just basically if they put AI in their earnings report, you're in?
I think it matters a lot, because we learned some hard lessons about things like the hype around electric vehicles, the metaverse, et cetera. And I shouldn't have used hype, because we are seeing it translate to real earnings results. You think back to what Microsoft released at the end of the fourth quarter, just as an illustrative example. Their contribution to their cloud services growth coming from AI doubled from the previous quarter. So this is happening. It's happening fast. And soon we would expect the impact to expand beyond just those enablers and direct beneficiaries, because we expect it to be a tailwind across a lot of different sectors.
You know, I used to have a daily segment. It was 30 minutes after the opening bout. Bramo would come on every single day with me on Bloomberg TV, and it was basically Bramo's worry. We'd literally finish the program. It didn't matter where the market was. Lisa would just talk about what she's worried about for the next 3 minutes or so.
That was
a
really
good
fun.
segment, wasn't it?
Great. Yeah. I would come on and just
I say this because the producer's wondering whether we should sort of bring back Bramo's worry of the day.
pick toggle bonds.
I think that should be like the final thoughts, final segment every single day. Elise, you're going to stick with us, I'm pleased to say. Elise Ossenberg of JP Morgan. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. It's the biggest day on the presidential primary calendar. Voters in 16 states and 1 territory head to the polls for Super Tuesday. Former President Donald Trump is expected to win a majority of the Republican delegates that are up for grabs tonight. He picked up 29 last night in North Dakota, sweeping the caucuses with 84% versus Nikki Haley's 14%. Activist investor Nelson Peltz wants to, quote, restore the magic at Disney. His Triumph Fund Management published in a 133-page white paper ahead of the company's AGM. It suggests a partner for Disney's traditional TV channels, a review of the studio operations, and a succession plan for CEO Bob Iger. A group formed by Trian holds about $3.5 billion in Disney stock and is seeking an overhaul of the board. Target up in the pre-market. Fourth quarter earnings beat estimates with better inventory management. Target has faced headwinds with shoppers buying fewer discretionary items thanks to higher inflation and interest rates. It's also launching a membership program to rival Amazon Prime and Walmart Plus. That's your Bloomberg brief. John.
Hey, Danny, thank you. The stock is up by something like 8%. They do not have the inventory issues they had coming out of the pandemic. Inventory down by about 12% in the fourth quarter.
Can we just take a second to realize how difficult it was to be a buyer during the pandemic?
Oh, I know.
I mean, if you think about the changing appetite, suddenly everyone wanted stretch pants, and then people wanted to work out, you know, to actually go back to work.
They bought it all. It took months to arrive. It arrived and no one wanted it anymore.
I mean, it just,
I
feel for them.
Tremendously difficult. That stock is positive in the pre-market. Up next on this program, decision day for Nikki Haley.
We're going to do as much as we can. I want to be as competitive as we can, as long as we're competitive. Look, 70% of Americans say they don't want Donald Trump or Joe Biden. That's not a small number.
And that decision, should she stay or should she go? That conversation up next.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
Equities down here by a third of 1% on the S&P 500. The bond market's shaping up as follows. We're down 4 basis points now on a 10-year. 416. Forgive the surprise as I give you the update on the bond market. Down 2 basis points on a 2-year. Been a quiet morning in the bond market, okay? Down 2 basis points on a 2-year. 458 on that 2-year yield. The big one next stop for this market is the economic data later this morning, 10 a.m. Eastern time, the ISM Services Index. Then tomorrow, ADP, JOLTS, claims on Thursday, then the big one Friday. The payrolls report just around the corner. Under surveillance this morning, it's decision day for Nikki Haley.
The voters can take the person out of the race very quickly, but a court shouldn't be doing that, and the Supreme Court saw that very well, and I really do believe that will be a unifying factor.
We're going to do as much as we can. I want to be as competitive as we can. We certainly have numbers that we're hoping for, but we'll see what happens tomorrow, as long as we're competitive. Look, 70% of Americans say they don't want Donald Trump or Joe Biden. That's not a small number.
Here's the latest. Nikki Haley making good on her promise to stay through Super Tuesday, despite polls suggesting voters will solidify a November rematch between Donald Trump and President Joe Biden. Rick Davis of Stone Court Capital joins us now for more. Rick, do we understand, do we know what the threshold is for Nikki Haley to stay in this race beyond tomorrow?
Yeah, I think she's got to be able to show people that she still has some level of competitiveness. I mean, like her low points have been the 20% that she's gotten in like Iowa, and her high points are 40% that she got in New Hampshire. So can she stay in that trading range enough to collect up enough delegates? I mean, her biggest hurdle is that half of these are winner-take-all states. So for over 400 of these delegates out of the 865 that are going to be picked are going to go to Trump because he can win the winner-take-all states. And then the rest are basically up for grabs, and, you know, we'll see how many she can collect.
We have a lot more closed primaries than we've had. What can they tell us about potentially Trump's and her when it comes to her staying in the race? Because a closed primary means if you're a Democrat or independent, you can't get involved in a Republican primary.
Yeah, that's right. She has benefited from the open primaries that have been going on so far. That's how she's accumulated the kind of percentages that she's gotten because she has a lot of crossover appeal. Moderate Republicans, conservative Republicans who don't like Trump, that'll be how she has to feed off of this. And there are current polls. Florida Atlantic came out with one today indicating that about a third of the Republican Party doesn't like Trump, doesn't want to vote for Trump, doesn't want Trump on the ballot in the general election. And so that's got to be where she gets the accumulation of ballots, accumulation of votes, accumulation of delegates. The question is, can she turn them out? She doesn't have an infrastructure. She does have money. And the question is the case that she can be making tonight after all this is said and done to donors is that, please, give me more money to keep my campaign going. Because if the money dries up, there's really no there for her.
Well, when you look at today's primary for both Republicans and Democrats, it's basically over. This is what Libby Cantrell-Pimco says. But then she goes on to say, and no, between now and then, we do not expect some other candidate airdropping in to replace Biden or Trump as the party nominee. Rick, a lot of people continuously are almost hopeful that the Republicans or Democrats have put forward someone else. Do you ever see a position in this election that we could see Biden or Trump dropping out?
You know, it's a weird phenomenon. They call them the double haters, people who hate both candidates. 70% of the country's voters want a different set of candidates, both of them. And so these double haters are not going to get any joy. Neither candidate's going to drop out. And the only thing that could cause either one of these individuals to not be on the ballot in November is a health concern. Obviously, with two guys, you know, in the age group that they're in, a health concern has to be something that you pay attention to. But outside of that, there's no political rationale for the parties dumping either one of these guys. So this is the pot that you're going to see. This is what you're going to be able to choose for. And frankly, I think it's been a big problem for Joe Biden because the idea that someone else is going to fill his shoes and be more attractive in the general election has really kept a lot of his enthusiasm down. That's a campaign that desperately needs to prove they're the candidate, they're going to be on the ballot, and they need to start generating some enthusiasm around that.
So, Rick, this is the pot that we've got. But do we understand this pot? I mean, this is sort of my question heading into an actual season where maybe we're going to hear about policy. Hopefully we hear something about what's going to happen with respect to tariffs, what's going to happen with respect to deficit reduction or lack thereof. I mean, are we facing something that could be, and I keep going back to this, a Liz Truss moment for the United States if a series of different policy measures are rolled out at a time where the U.S. is facing a resurgence in growth, but also inflation?
Well, I think we're going to get a really clear indication of that on Thursday night during the State of the Union. Does the president put out an agenda for the future? What is his claim to a second term? What's he going to do? It's totally unclear. Most of it has been rearguard actions, fighting over immigration, trying to demonstrate success on the economy. But we've heard very little from Joe Biden on what is the plan for the next 4 years. If he wants another term, what's he going to do with it? I don't think you can expect any of that from Donald Trump. Donald Trump is Donald Trump. He's saying exactly the same thing on the stump today that he said in 2016 and 2020. So none of that is likely to change. I don't think you're going to see a lot of new policy prescriptions out of the Republican side of this equation. But I do think the onus is on the president. He's the governing leader of the country. What is it that he's going to offer to voters in the general election that's different than what he's doing today? Because what he's doing today is not going to get him a victory in November.
Well, Rick, that means a complete change in strategy, because at the moment, his whole pitch is, I'm not him. And that was the pitch last time around. Are you saying that's not going to work this time?
Well, look at the Bloomberg surveys of swing states. I mean, he's losing every single one of them. The pitch is not working. And so if he does not find some space where he can communicate a new policy toward immigration, now rising up to, in many states, the #1 issue, it's overcome the economy because, frankly, voters are starting to get more comfortable with the economy. They actually are going to reward Biden with some support on the economy for a change. And so he's got to be able to address the concerns that the country has. And one of those, for instance, is immigration. He goes down the border last week, same day as Trump. Trump just lambasts him about his management of the border, and Biden shows no effort to try and give us a new prescription for his administration on the border. He is, in our last survey, only getting 25% approval rating on the border. I mean, it's absolutely the worst issue for him in the country, and people are galvanized by the headlines about, you know, the massive amount of people coming across the border and making their ways to cities all across the country and creating a lot of pressure. And
Rick,
he's got to release some of that pressure.
We've got to go. It's good to catch up with you, though, sir. Rick Davis of Stone Court Capital. We've got to go because it's that time of the hour where I turn to a market guest and say, forgive me. We're going to talk about politics. At least forgive me. We're going to talk about politics. How much thought are you giving this right now? Can you avoid it, at least for the next few months?
Oh, we cannot avoid it. It's coming up in every meeting. I think the welcome thing for a lot of people, though, is at the very least, we know what we're getting with both, right? We're in the midst of a Biden administration. With Trump, we already had 4 years of that. So there's perhaps a little less uncertainty associated with this election, but nonetheless, you know, the nerves are still there.
You say we know what we're getting with both, but you all remember that night in November 2016 where equity markets sold off aggressively, then they got bought back. We all remember the acceptance speech. He starts talking about infrastructure and everyone's like, oh, okay, let's focus on the policy. We might get some tax cuts. This might be good. We start talking about the Trump trade. A few years down the line, we start talking about tariffs. How different will it be? I just wonder whether it is going to be the same this time around.
To Rick's point before, I think Trump is still Trump. He's talking about tariffs. He's talking about things like deregulation. He wants to make those provisions of the Tax Cuts and Jobs Act permanent. And so that's helping us a little bit kind of lay out a scenario analysis. And broad brushstrokes, this might end up looking like something, if Trump does win, you know, potential dollar strength and a little bit of upside for yields. If people get, you know, more concerned about things like the deficit, it could be good for small and mid-cap equities that are more domestically focused. But I think either way, what we're encouraging investors to focus on is what they can control. So let's think through how to make your portfolio more tax efficient. Let's talk about bigger picture global themes that are probably going to play out regardless, like security, for example.
Well, when you talk about yields being a little bit higher, I mean, that's sort of what I was referring to with the Liz Truss moment. When do you sort of jump the shark in terms of talking about protectionist policies at the same time of potentially slowing growth and inflation that still is a problem? At what point do higher yields really derail some of your investment thesis? Where is there sort of like a line in the sand that really becomes concerning?
If we're using the 10-year kind of as our reference point, I think 4.5% is where we once again start to pound the table on duration, because we think that's probably the sustainable ceiling. Maybe you see, a tick up higher, closer to those 5% levels that we had in the fall. But 4.5% is what gets us excited about seeing a little more value in terms of interest rates, because ultimately over the long term, we do still think it's going to be Fed policy that's going to drive that longer term yield level.
I'm going to have you make this a thing. All right, we're going to talk about this every day for the next few days.
I'm going to, and everyone's going to just completely ignore me.
I'm so on board
They're
with you.
going to say, Liz Truss is not relevant to the U.S. political backdrop, and that's going to be a key question, is it?
I'll go back to the same question I always ask. Does Washington retain the privilege of acting recklessly with the nation's debt? Yes or no?
You and I will be the only people talking about it, because everybody else just says, you know what, it's Fed policy. They've always operated like this. But we'll keep trying.
Elise, enjoyed it. It's good to see you. Elise Ossenberg there of JP Morgan. Let's turn to the equity market. This is where equity futures are right now on the S&P 500. Then I'll tell you what's coming up next. Equity futures on the S&P right now negative by 1/3%. We are lower on yield on a 10-year, down by 5 basis points at 4.16. Sneak peek at a 2-year, we're down 2 basis points. Your 2-year yield this morning, 4.58. Coming up next on the program, Lauren Goodwin of New York Life Investments weighing in on what investors will be watching as Super Tuesday results come in. Lauren Goodwin on the politics and what it means for financial markets, which sets us up for the perfect question, really, the prospect of a Liz Truss moment in America. Do you like that?
Yes, that was so good. I knew it was coming.
Again.
It was so good.
Let me do that again.
Let's do that.
Which sets us up for the perfect moment, really, the prospect for a Liz Truss.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups, is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
At the perfect time, and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
This
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
0.4%. NASDAQ, we're down by about 0.6. Real reasons for that underperformance. Tesla and Apple, two pieces of that puzzle. In the bond market, a 2-year, 10-year, 30-year with a yield that looks like this. A 2-year yield down by 2 basis points to 4.58. 4.1584 on a 10-year. We're down 5 basis points. Lisa, going into that economic data 90 minutes away.
Yeah, assessing after we got a little bit of a sell-off, but then people saying that maybe Constant Hunter's view of things is correct, that the disinflation does continue. Ultimately, and you've asked this question before, how many hot prints does it take for people to believe that maybe this inflation is not fading as quickly as some had hoped?
If February confirms January, we go another step in that direction, that's for sure. I'll keep going back to that line from Kit Jukes of SocGen. We are feeding on a diet rich in US exceptionalism. The dollar's feeding on that. Euro dollar right now, 108.46. Dollar a little stronger, euro a touch weaker on that currency pair, negative by something like 0.1%. Want to get to those two stories for you. Apple and Tesla under pressure in China. Data from Counterpoint Research showing iPhone sales in China slumping 24% in the first 6 weeks of the year. The slowdown coming even after Apple introduced rare discounts to stimulate demand. And Tesla is set to extend losses after data from China's Passenger Car Association showed shipments plunged in February. The EV maker shipped just over 60,000 vehicles from the factory in Shanghai. That's down about 16% from the previous month. AMH, we're trying to work out what is going on in China.
Well, is it a growth issue? And it's funny because we obviously have the growth targets for China today, and even they're saying this can be difficult to reach, quite ambitious, is 5%. Tesla and Apple both cutting their product price points, but they're still struggling to remain competitive. And everyone is talking about two things. One, growth, on the other hand, is part of this patriotic buying from Chinese consumers who are shunning American products and saying, well, we have a Huawei phone we can buy for cheaper, just as good as Apple, and it's Chinese.
That last point is really important. The fact of the matter is that Apple dropped prices and the competitor still took market share. That's a big problem in your second biggest market.
Can they address it, given the fact that it's not just the end consumer, but it's also the production of it? There are a lot of questions for Apple to answer. My question is this just an Apple and Tesla story, or is this a broader issue? Pretty much everyone who I ask says it's just an Apple and Tesla story. So I'm going to keep asking, and everyone's going to keep saying that, sort of like the Liz Truss moment when everyone's saying, you know, ultimately the U.S. exceptionalism will roll out.
Stay tuned. We're going to return to the Liz Truss question in a moment. Apple's down about 2% in the free market.
Can't wait.
Want to turn to the nuances of this story. Israeli War Cabinet member Benny Gantz meeting with top officials in D.C., including Vice President Kamala Harris. Harris pressing Gantz for a pause in fighting and a deal to free hostages, but praising what she called Israel's, quote, constructive approach to seeking a 6-week ceasefire. The Biden administration continuing to push Israel on getting humanitarian aid into Gaza. Punchbowl News reporting that Senate Majority Leader Chuck Schumer is set to meet with Gantz today. Now, Anne-Marie, you can frame for us the distance between Gantz and Netanyahu in this visit.
Well, this is huge because also Punchbowl News is reporting that Speaker Johnson is not going to meet Benny Gantz. And the issue that is going on in Israel is between Netanyahu and Gantz. Gantz is more of a centrist. Many analysts say if an Israeli election was held today, he'd be the one to win, which is why Netanyahu apparently had a very frank conversation with him before he flew to the United States saying, remember, there's one prime minister of Israel, and that is me. And that's potentially why you see Speaker Johnson wanting to put some distance and not wanting to take this meeting with him.
How much of what happens today spills over into the address from the president Thursday evening?
Well, I think what Kamala Harris said the other day over the weekend, speaking in Alabama, talking about immediate ceasefire, talking about the dire conditions of Palestinians, I think you're going to see a read-through to the president's speech on Thursday. NBC is reporting that actually she was going to be a lot tougher, and they watered down her speech. So potentially you're going to see the president ramp it up and his pressure on Israel.
That's policy. Let's talk politics. Voters heading to the polls in 15 states for Super Tuesday. But compared to other years, the excitement is all but gone. Donald Trump is practically guaranteed to clinch a victory over the last remaining GOP rival, Nikki Haley, effectively ending her presidential bid. This as President Biden faces no serious challenge of his own, but Democrats will be closely watching so-called uncommitted protest votes over his handling of the war we just discussed. So talk me through, say, Michigan, what that looked like there and what you expect this to look like tonight.
Well, for Michigan, the big question there was, of course, for Biden. This is a swing state. You saw over 100,000 individuals come out and vote uncommitted. Now, these are people who likely voted for Biden in 2020, and this was a protest vote. So I think what Biden is struggling with is shoring up those individuals that voted for him in 2020, some of them a part of his base. Trump has the base, which we continuously to see in these primary states. The issue he has is winning over the Nikki Haley electorate, those Republicans who are more moderate, or those potential Democrats who don't want to see another 4 years of Biden, who would have maybe voted for Nikki Haley. That's the issue Trump's going to have when it comes to the electorate, expanding that base.
Here's the view on Wall Street on that issue. Lauren Goodwin in New York, Life Investments, saying that no matter the outcome of the Super Tuesday contest, markets will be watching 4 areas of policy, including how much money the government spends, where the government spends that money, foreign policy, and migration. Lauren, I think you know where this conversation is going to go, so good morning to you, and we'll get straight to it. How you doing? Let's talk about it. The Liz Truss moment. Do we face the prospect of one later this year in America?
I don't think we've faced the prospect of one later this year, but the question is so important because what we've seen from both of these administrations is that they are very willing to spend. And what they spend on, of course, is different. That has sectoral impacts for investors. But the reality that the deficit is likely to continue to be, in a long-term sense, unsustainable is really important. It's one of the reasons why we expect long-term interest rates to be volatile and that to be an important part of portfolio construction ahead.
So people could have said that the deficit was important a year ago. Why is it suddenly going to come into the fore in a more significant way, given the fact that everyone's been saying, oh, it's going to matter, and then it just hasn't mattered, auction after auction, no matter how much we talk about it?
The tricky thing about debt sustainability is that it's death by 1,000 cuts. You can make mistakes over and over and over again, and it's not clear whether it's the 17th or 25th mistake that results in your Liz Truss moment. But that is something that as not only the level of debt, the flow of debt, but also the cost of debt in the U.S. economy becomes more important. So again, in the near term, when we think about portfolio construction, that's about rate volatility as opposed to necessarily an upheaval of the U.S. debt markets, which are so much deeper and well-capitalized relative to even the U.K., which is, of course, an already well-capitalized economy. But it remains an area where as governments continue to show profligacy, we should expect at least the conversation among investors to continue.
When you talk about portfolio construction and higher yields as a result of some of these debt concerns, which a number of different investors are talking about, at what point do those higher yields become punitive for asset prices in a way that is underappreciated?
I agree with what Elise said earlier, which is that 3.5% to 4.5% range on the 10-year right now is very reasonable. Let's first note that that's a wide range of reasonable outcomes for the 10-year relative to history. So again, speaking to the volatility, I think 5% is where we really start to see significant pain and likely a credit event in the U.S. economy. Now, we're nowhere near that right now. But to be honest with you, duration and interest rate volatility in a one direction or another isn't our favorite place to take risks. So while we expect the Fed's next move to be a cut, and we've been moving into short duration credit to lock in higher yields, we've been balancing it with long duration municipal bonds as a way to sort of draw that equivalency and make a more neutral duration play.
This conversation started with how much they'll spend. Can we turn to where they'll spend it? The sector plays. What other sector plays right now for you? Where are they going to spend that money?
There's honestly, compared to what you would call a stereotypical Democratic versus Republican platform, not as much difference potentially than in past elections. One area where we see both administrations having already spent and expect them continue to spend is in brown energy. It's one of the areas of policy that there's so much investment in the Democratic administration towards infrastructure, which we expect would be sustained, that brown energy doesn't leave the playbook entirely.
Where do you see them the most far apart?
Couple of areas. I think the extent of green energy and infrastructure investing, I think, is incredibly important, and that's a global theme. That's something that is important not only in the global equity but also global bond markets. Another area where we see pretty major differences is in migration, immigration, and when it comes to defense of border policy spending there compared to the more traditionally balanced, focused on educated immigrants. These are areas where we see just big differences, and not just approach, but also the root of the policy themselves.
If they're going to be big differences when it looks at migration, how is that going to spill over to the economy? Because it can be very different in terms of the labor market.
That's right. So widespread increases in immigration over the past couple of years have played a role in the health of the labor market as we've seen it so far. And here I'm speaking strictly on economic terms as opposed to political terms. We looked at what would the exact opposite situation look like. Let's say you had mass deportation of undocumented workers in the US. We actually have some good historical examples in individual states of what those policies look like. And by the math from our research, you would see a 5.7% decrease in GDP growth if such a policy were to take place. Now, that's an extreme policy. I think it's very difficult to carry out. It's nowhere near our base case, but that's the type of difference you're seeing in terms of labor market knock-on effects.
I can spot one thing where there's not much daylight, and that's international trade and national security becoming one single issue for this administration and a previous one as well. How are you thinking about trade in the years to come?
This is one of the areas where I think the approach towards policy is quite different, but the policies themselves have shown not to be very different at all. The reality is that for the competitiveness of the global economy moving forward, you have to be involved in energy and in semiconductor production. There's been so much focus on bringing semiconductor production back to the US that is not distinct between the two presidents. Again, the approach and the language around those changes are different. And specifically with respect to trade, I would expect to see a more likely uptick in tariffs in a Republican presidency as opposed to a Democratic presidency. But we haven't seen tariffs rolled back in this Democratic presidency. So the core of the policy, the idea that the U.S. or U.S. allies need to be an important part of semiconductor production ahead, very, very complicated supply chain, that's impacted not only the political environment, but also investment. We haven't seen deglobalization. It's a reglobalization with lots of money being spent to make this happen.
How much have we accurately priced the ramifications from that in, say, some of the big tech players? And I say this today with Apple and Tesla, both seeing the effects of potentially both the slowdown in the Chinese consumer as well as the geopolitical risks. How much is that a headwind in a way that isn't really being talked about enough?
The reality for the Magnificent Seven that have been so central to semiconductor production and use in the US and really the global economy so far, that enthusiasm, we believe, is correct. The challenge is that it's 7 companies. And so there are going to be idiosyncrasies in their demand, in their supply chains that are likely to cause tumult, and we're seeing it today. And I think it's important to note that in the dot-com bubble, what cracked the whole system wasn't somebody, really failing to present earnings. It was Cisco having about 50% projected growth instead of the expected 60% projected growth. So we can still have incredibly strong, profitable companies and see valuations move lower. The way that we balance that from a portfolio construction perspective is to acknowledge that these companies are they're showing strong profitability, good quality, but they're not diversified. So adding an application layer of small and mid-cap growth companies as well as a digital infrastructure layer, we think makes a nicer package to stave off some of those idiosyncratic impacts.
Plenty of companies didn't present earnings in that time, and as you know, stocks carried on going higher. That was distinct about that time. Look, is this about sectors, tech, which you're talking about, or size? Is it small versus large? Because large multinationals are just going to have such a difficult time with the policy changes that we're starting to see.
But what we heard from Pierre Ferragu was that in a number of the big tech names, people are pricing in no upside from China. That's not the same for Apple and Tesla that are much more intricately connected to them. So it raises this question of, is it just sort of the known knowns, right? That people are sort of pricing this in, or could you get some sort of black swan event, and it sounds like nobody is saying that there could be a black swan event.
Someone will come on soon, Bramo, I promise.
There could always be a black swan event.
Thank you for
That's
that.
the nature of black swan events.
That's good.
Trying to keep her happy, Lauren, all right? Lauren Goodwin of New York Life Investments, thank you very much. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Americans are now paying nearly as much interest on other debt as they are on their mortgages. New data from the Bureau of Economic Analysis says interest paid on everything from credit cards to student loans has hit an annual rate of $573 billion for January. That's the highest on record. Americans are currently paying $578 billion in annual mortgage interest. NYCB higher in the pre-market by about 1% after it plunged and had more downgrades yesterday. Shares of the company dropped to a 96 low, falling 43% in 2 days. Fitch cut its rating and Moody's lowered theirs again after already rating the bank at junk. NYCB has lost more than 2/3 of its value this year. Counterpoint Research says iPhone sales in China fell 24% over the first 6 weeks of this year. To stimulate demand, Apple offered a rare discount on its site in stores in January. Apple fell below a 16% market share from 19% a year ago, according to the researchers. Apple shares have fallen 9% since the start of the year to lose the title of the world's most valuable company to Microsoft. And that's your Bloomberg Brief. John.
Danny, thank you. That stock is down by 2%. Is that enough, Liz Truss, today? We're done for today?
I'm done.
Okay, cool. Up next on the program, Tesla hitting the brakes.
I think Tesla is more or less finding a floor in China and in a place where they can maintain the kind of volumes they've been selling in the country in recent months.
That conversation coming up next. We're 45 minutes out from the opening bell. Equity futures on the S&P 500. Near session lows, negative 0.4% from New York City. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3 as the economic picture, covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Live from New York City, cash open just around the corner, 42 minutes away. Equity futures on the S&P 500, lower all morning, negative by 0.4%, near session lows right now. Bid in the bond market, yields are lower by 6 basis points now. Session lows on the yield on a 10-year, 4.1545. Under surveillance this morning, Tesla hitting the brakes.
All EV makers have had to lower their prices a lot in order to maintain demand. We've seen a game of market share moving back and forth between BYD and Tesla. I think Tesla is more or less finding a floor in in China and in a place where they can maintain the kind of volumes they've been selling in the country in recent months.
Here's the latest today. Tesla falling after its China shipments plunged to the lowest level in over a year, according to prelim data from China's Passenger Car Association. Shipments for the EV maker's Shanghai factory falling 19% year over year. The stock is down nearly 25% year to date. RBC's Tom Narayan saying this: Tesla has in the past indicated plans to eventually reach 20 million vehicle sales per year. While we can envision a scenario where it becomes a major player in the US on a unit sales basis, we do wonder if national champions in Western Europe and China limit Tesla's ability to gain similar market share levels. Tom, I'm pleased to say, is with us around the table. Tom, great to have you with us. Let's just start with the news out of China. How very real is the slowdown in the Chinese market?
I think you also have to take it with a little pinch of salt. Remember, there's some tough comps here with the China New Year that happened in February. I mean, BYD went from 200,000 units to 120,000 units. So it's the entire market that happened. That's not to say that this growth isn't slowing. We knew that. Elon was talking about it on the earnings call. But we're in a lull period between the Model 3, Model Y, and then the upcoming affordable car to come in 2026. Remember, this is a very long-term story when you think about Tesla, right? So you have to look at it from that lens. Certainly there's a slowdown happening, but I don't think it's something that folks should be overly worried about.
I'm happy to have the long-term conversation. There was a phrase you used, and it was national champions. And I just wonder, is that what we're going to end up in the world of EVs? We're going to have a national champion in China, a national champion across Europe, and a national champion here in America. Is that the direction of travel?
I mean, that's always how it's been, right? No automaker in the history of autos has ever gained more than 10% market share. There's a reason for that, right? It's geopolitics. And, you know, for that reason, we actually only see Tesla gaining maybe 5 to 5.5 million cars sold a year at peak, at maturity. For it to gobble up 20 million cars a year, what happens to GM? What happens to Ford? What happens to Renault? What happens to Stellantis? I mean, you could see governments will step in and probably not allow that to happen.
There's a real issue here, though, and Tesla might have a long-term good story with respect to being a dominant auto manufacturer, but maybe not as much on the valuation side when it turns out it's a car company. It is not a tech company in a sort of an exclusive way, the way that some people would like it to be. Does its valuation have to reset as a result of dealing with these sort of national champions and geopolitical tensions and some of the ebbs and flows of just the natural demand for these vehicles?
I think if you think this is a car company, you should stay away from this stock. My valuation for being a car company is only about $80 billion. And my price target assumes a $1 trillion valuation. So most of my valuation is actually on non-car things. It's autonomy, robotaxi, FSD, and Megapack. This is battery storage, which is a tremendous opportunity. So I think you have to look at this company beyond being a car business. No car company has ever been worth more than max $100 to $200 billion anyway. So you really, unfortunately, have to look at this company from a lens outside of being a car company.
How many of those other subsets, the autonomy, the robotaxis, are hinging on anywhere other than the United States? I mean, are these really U.S.-focused efforts at a time where people are looking for that kind of isolation from the geopolitical tensions?
That's a great question. For me, my valuation is predominantly on the U.S. for these things. A lot of people don't realize the robotaxi market, auto market's about a $3 trillion market. That's like the box on wheels. If you add robotaxis, autonomy, that takes share from planes, trains. It's a living room with wheels. It's a bedroom with wheels. It's an office with wheels. The TAM could explode to $4 or $5 trillion.
Okay, hold on. Okay, back up for 1 second. Okay, a living room on wheels. It takes away from trains, planes, and automobiles. Okay, at a certain point, isn't it sort of the top is in if Apple's like, I'm out, this isn't really going to happen? I mean, doesn't that sort of send a signal that this has sort of gotten over its skis?
I don't think so. I think autonomy, specifically robotaxis, could be the most significant thing to happen in our lives, honestly. It's going to save spaces in our cities. How many of us know somebody who's died or been impacted in a car crash? It eliminates that almost entirely. Legislators will regulate this. Their FSD product, which is already on the road today, is tremendous. And we're going to get the version 12 that's going to come out this year that's going to solve a lot of the problems that it faces. So even though autonomy is a long-term thing, we have steps that we're going to get us to where we think they're going to get.
Before going to flying living rooms, I want to go back to the nationalism. In China, they control everything from the raw materials to processing a battery. At what point, if they're going to really become nationalistic? Do they just say we are no longer exporting these batteries for every other company to make electric cars? Every other company to make electric cars, you have to buy our car.
Yeah, no, I don't think they'll do that. I think they're overly dependent. Let's be honest, like Tesla, Chinese exports right now of their EVs, it's like 1-2% of total autos in the U.S. and Europe, really. So they really are dependent right now on selling a lot of their battery infrastructure into European OEMs and eventually into U.S. OEMs. They want to build factories in Hungary and in Mexico and sell their cars overseas. So they want to sell that stuff. It's the opposite. It's whether or not the U.S. will be an obstruction to their OEMs purchasing those batteries.
Tom, you said something interesting about GM and Ford, Stellantis, that potentially the U.S. government, you alluded to this, the U.S. government wouldn't let them fail. If this becomes a state-sponsored industry, is the government really going to allow shareholders to take all the upside? How's that going to work if ultimately the U.S. government has to step in?
I mean, this industry has a long history of the government stepping in.
Tons of it.
And supporting this industry.
But this feels like a government objective, not for these manufacturers to survive, but the end point. They've set the goal. You all need to turn to EV. This is something they're pushing, and that is new. That's a change.
That is a change, but we're starting to see some language pull back on that a little bit. Look what happened to the UK, right? Pulling back on the 2030 target, going to 2035. We're hearing about some in the EU talk about, maybe loosening up Euro 7 restrictions. So I actually think governments ultimately, look, what is their goal here? Jobs, right? Yeah. So they're going to want to protect jobs no matter what. And if it means loosening some of these targets, some of these restrictions, that's probably what they'll do.
Got to ask why, though, and isn't that a risk factor? That actually the consumer right now is interested in hybrids and not a pure EV play?
That's true. We're seeing that predominantly in the U.S., maybe less so in Europe. But I think you have to look, this, what is that old saying, progress doesn't move in a straight line, but it bends towards justice, right? So if you were to view, EVs as something in that, that moral compass, we're in a lull period, right? That's what Elon calls it. We're in a period where the early adopters gobbled up their $70,000 Teslas. Now the mainstream market doesn't really know what an EV is. It's an education process that'll take some time. We also need some EVs that people want, right? There's enough of these crossovers. We need some SUVs. We need some pickup trucks. So we'll get there. Battery prices will come down, right? So it just takes some time, but we'll get there.
Tom, it's good to see you. Great to catch up. Thanks for giving us your thoughts. Tom Naran there of RBC. Coming up tomorrow, we'll catch up with Liz Ann Saunders of Charles Schwab, Carl Riccadonna of BNP Paribas, Kelsey Berrow of JP Morgan, Kate Moore of BlackRock. A double dose of Chairman Powell on Capitol Hill begins tomorrow. Then it's onwards to the payrolls report on Friday. From New York City this morning, good morning to you all. This was Bloomberg Surveillance.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Ferro. Tech under pressure, battered and bruised from doing business in China and with China. But the victory lap, it's gold, record high. Countdown to the open in stocks kicks in 30 minutes.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Coming up on the show, markets on edge ahead of Chairman Powell's key economic data. Target delivers a beat, while Apple and Tesla sales disappoint in China. And Super Tuesday gets underway with Trump on the cusp of the GOP nomination. We begin with a big issue, hawkish Fed speak setting the stage for Chair Jay Powell. Atlanta's Raphael Bostic expecting the first cut to be followed by a pause, saying, quote, this: given the uncertainty, I think there's some appeal to acting and then seeing how participants respond to that. I probably wouldn't anticipate back-to-back rate cuts. Mike McKee is with me now. Mike, this is about a redux of 1995, isn't it? Good morning.
Good morning. Well, it could be seen that way. It's an interesting position from the Atlanta Fed president, who has been dovish in the past, but now he's talking about maybe only one rate cut this year. And if that's the case, when do you do it? There's a question that will face Jay Powell up on Capitol Hill. Here's when they have meetings this year up until Election Day. The last one, November 7th, 2 days after Election Day. Do they wait that long? Do they do it in September, just before Election Day? There's going to be a lot of questions about whether the Fed is going to be politicizing rate cuts. So I've got a quote for you here. This is an American humorist, in case you haven't been familiar with Will Rogers, but he once said, in an election year, politics is applesauce. At that time, it meant nonsense. And here's Jay Powell saying, we don't consider politics in our decisions. We never do and never will. That's the answer you're likely to get. But the question then becomes, what will drive their decisions? And that's where Bostic comes in with a little bit of worry here. He's pointing out that the inventory levels around the country are very low. And you can see here the ISM manufacturing came in low this week and pretty much down where it was at the height of the pandemic. And we'll get the services number at 10 o'clock this morning, and that suggests businesses may want to rebuild their stocks, and that may mean a stronger economy rather than one that's pushing inflation down. Here's Bostic's quote on that. This threat of what I'll call pent-up exuberance is a new upside risk that I think bears scrutiny in coming months. As my staff and I have talked to business decision makers in recent weeks, the theme we've heard rings of expectant optimism. Did you notice that word, exuberance? Somebody else used that word, Was it back in 1995?
Ooh. Full circle. Mike McKee, well done. Mike McKee setting the stage from Mr. Bostic. Let's continue the conversation now with people at Money at Play in the markets. Invesco's Rob Waldner and Cara Murphy of Castra Investment Management. So here we are. This is 2 weeks apart. Jefferson talked about careful easing of 1995. Here we are, Bostic putting on the table or flying the kite, whatever way you want to phrase it, of one and done. Rob, good morning. What does careful mean, supplanting the word transitory?
Good morning. Good morning. So I think what we're hearing from Bostic is there's a lot of uncertainty in the markets right now because the recent data that we've gotten in January, I think, was quite noisy. We think there was a lot of seasonal issues in the labor market data, seasonal issues in the CPI data, in the retail sales data, because we have some new seasonals and a lot of volatility coming out of this post-pandemic period. So I think it's going to be important to see the next month or two. We're going to start to get this February data, look at the March data, see whether January was a bit of a fluke, because I think a lot of people have been sort of shading their views based on this January data, which we think there is some seasonality to. So to get to the point here, you know, Mr. Bostic is looking for a rate cut and saying they may pause. I think we just need to see how the data evolves here. I think we'll get 3 cuts this year, probably 3 to 4 cuts, because the Fed has really delivered this soft landing, and why not cut rates in that kind of environment?
Well, yeah, but he warns against this exuberance. Good morning to you, Cara.
Morning.
So here we are. I put it to you, this is Bostic flying the kite ahead of Powell to deliver the cover that they need. If it was 1995 and it was one and done in the autumn, how does that play out for risk?
So I think what's very interesting in this whole story is that it's the Fed that's been super consistent in terms of what they're forecasting for Fed rate cuts. You know, late last year, we had the pivot party when the Fed started to incorporate 3 rate cuts this year. Market immediately started pricing in 5 to 6. Now they're back to 3 to 4. So yes, the Fed typically puts up these little trial balloons in the form of individual members commenting, speculating, talking a little bit more about their inner conversations. So I think this is the Fed sort of testing out the market. How will the market respond if the Fed is yet a little bit more even conservative in terms of when they start cutting rates? And I think the market is telling us that they don't care all that much. As long as there are some Fed rate cuts on the horizon, the market is feeling that the economy is resilient enough to be able to handle that.
But there is a consequence of that higher for longer, Cara, and you make it very clearly in terms of understanding the debt level in the broader market. Everybody's telling me reach for breadth, go, perhaps even go for value, not perhaps the JP Morgan house. They still want to cling on desperately to growth, but contextualize the risk as we go forward in the Russell 2000 if we remain in this higher for longer.
So there are a number of different implications. And you know, we've written about the fact that there are wide swaths of the economy that are actually very inoculated from higher rates. Think fixed rate mortgages or fixed debt on the corporate side. That said, you have areas where we've started to see that risk kind of filter in. Think credit card debt for consumers. Think high yield or small cap companies, as you mentioned, who are starting to face those higher interest rates. So the longer these rates stay higher, the wider that pain starts to become. So it's not that this economy is super resilient and can stay at this level forever, but it does mean that we have a little bit of room because the areas of the economy that are suffering with the higher rates are still fairly narrow. Now, that said, we think that there are some really interesting opportunities once you start to get out of some of those mega cap names because the market has been so concentrated there.
Yeah, and it has, and we'll come back to the froth concept in a moment from Kalanovic. But Rob, let me bring it back to you. I know that you put your stall out very clearly, and that's what makes a market. You're 3-4 cuts. The market's now shaving itself back. It's worried about the dots. You could get the dots taking us down to 2 cuts. How does that translate then to steepeners? Because what people are saying to me on the IB is that that really challenges the ability to hold these steepeners going forward.
Well, the reason that you need to you'll get yield curve steepeners here is as the Fed rate cuts rates, you know, we think that the long end of the curve is probably not going to move very much. So the longer term level of rates is probably not too far from where we are now over the next year or so. But so we're sort of approaching rates overall from a range trade. But if you start to, as the Fed cuts rates, and then as you start to price in more, you would get that short end coming down. So the key is it's hard to extend out in duration because of that negative carry that you get by extending out. And that's why we prefer to do steepeners looking at that short end of the curve.
Well, let's deal with Goldman Sachs versus JP Morgan and see what the two of you make of it, because we've got Mr. Kalanovic over at JP Morgan. He's talking about volatility and froth. Investors may be assuming that the increase in yields is reflective of economic acceleration, but earnings projections for 2024 are coming down, and the market appears too complacent in the cycle. Cara, are we too complacent? Is there a bit of froth building in this? And if so, where does complacency lie?
So I think we're starting to see a little bit of froth in the market, but nothing on the extreme. So, when we look at something like the AAII bearish sentiment, we're at lows that we saw in 2021. But other sort of technical measures, which are often a good indicator of froth in the market, are not really there. And then also when we look at some of the very concentrated areas of the market that have done well, they've been supported by stronger earnings forecasts, by, better operating margins. So, at this point in the cycle, we typically see earnings expectations coming down a bit for the forward year, and that sort of decline doesn't look to be outside of our historic experience right now. So, a little bit of caution is warranted, and looking outside of some of those areas that have gotten a little bit exuberant, we might say, but we don't think the overall market is suffering from a great deal of froth.
Let me throw a bit of exuberance back at Rob. I mean, those credit spreads, who cares what I think of credit spreads, but I am curious to know if you think that good behavior and that tightness in credit spreads can endure. But of course, if you're going for 3-4 cuts, it will. I would take the other side of that trade. But is there exuberance in the credit market?
So I think the right way to think about this is in terms of the market narrative, which if you go back over the last 18 months, we've had several different market narratives that have developed. There was the recession narrative at the beginning of last year, then there was the higher for longer. And I think the market has now settled on this U.S. economy grows very strongly for the rest of the year kind of narrative. Famously, we've had quite a few people coming on press recently talking about that kind of narrative, which is there's very few people looking for recession, very few people looking for that much slower growth. So I'm not sure I'd call it exuberance, but I would definitely say the narrative is very positive. So that creates a sort of downside risk for the market if things evolve in a different fashion. And, we just saw like the Atlanta GDP Now data, which has been indicated, which has been very good, is now looking for 2% growth in this quarter, which, that's we think we're in a kind of that sort of growth environment. So if you do get some downside from there, that would be, I'm not sure I'd call it exuberance, but the market is certainly priced for a very good outcome.
Okay, Cara, I'm drawn to I love the line in your report, which is you can buy prime rib for hamburger prices. I mean, that just makes me want to go out and sort of buy everything. So where can I get that kind of a deal?
Well, I mean, one of the more extreme examples of this is we touched on this a little bit in small caps. So you think about S&P and NASDAQ hitting new highs every day. The Russell 2000 is still 15% below its previous peak. And then when we compare valuations among those two sectors, you have large cap valuations typically run about 40% above small cap valuations. Today, they're running 100%. So as you think about, anytime you get out of that, whether it's the Magnificent Seven, the Fab Four, whatever you want to call it, you start to have much lower expectations, much lower valuation levels. I mean, another area is quality or value. There are a lot of these other factors that have kind of been left in the dust.
Okay, well, one that's not in the dust today, it's Target. We're going to talk about that in just a moment. Thank you very much. Stay with me. We've got more work to do. Rob Waldner and Cara Murphy. My guest this morning on markets. Let's look under the hood. As ever, 12 minutes into the show, Abigail Doolittle is with me on the Sector Watch. What have we got ahead of the opening bell?
Well, let's take a look at Target because their shares are popping sharply higher. This, of course, on a strong quarter where earnings beat by 27%. They put up nearly $3 in adjusted earnings, a stock up 9.3%. Sales were less than 1% 10% better. So this really speaks to improved inventories. They have less of a need to mark down, and that should carry forward. So a little bit of a relief here on the expectation around negative comp sales. Tesla down another day, potentially down 2.8% right now after falling 7% yesterday, the worst day since the end of January, of course, and shipping a little more than 60,000 vehicles out of China. That was the lowest number in a year. And speaking of China, well, Apple continues to tumble. Its correction deepens, down 2.2% in this pre-market. iPhone sales down 24% in the first 6 weeks of the year. They slipped to fourth in terms of smartphone choices in China. And again, Apple is in a correction, even as you have the S&P 500 all-time high. Something to ponder, Manus.
Yeah, it's certainly taking a hit in terms of those iPhone sales and competition inside China as well as demand. Abby, thank you very much. Coming up in the show, all eyes are on Washington. Super Tuesday gets underway.
If you're holding up your M&A transaction or other kinds of, investments because you're waiting for a signal on November 6th, day after U.S. elections, better plan on a longer time horizon before there's resolution.
Donald Trump moving ever closer to locking in the GOP nomination. Super Tuesday in review on Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
This is Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
There have never been so many variables at play, both in terms of producing polling projections and weighting the variables, and the high likelihood of disputed outcomes at least dragging out a conclusion. So what I am saying is, if you're holding up your M&A transaction or other kinds of investments because you're waiting for a signal on November 6th, day after U.S. elections, better plan on a longer time horizon before there's resolution.
So it could be bumpy even after the election. Super Tuesday kicks in America today. Voters of 15 states are going to hit the polls, with the outcome expected to set up the November rematch between President Biden and Donald Trump. Bloomberg's Anne-Marie Horder joins me now with more. You've been waiting for this, Anne-Marie. You're going to have a busy 3 days and no sleep. Set the table for me. Good morning.
Well, today's less not so super Tuesday. It's kind of a snooze Tuesday because it's pretty much decided that it's going to be a rematch of 2020 between Trump and Biden. You have the Democratic Party that are going to be hitting up 15 states, as well as the Republican Party. But what we can look at this is potentially some nuances when it comes to the voting. Besides Missouri and Idaho, where that had their primaries for the Republican Party, what we saw with the former president is that he hasn't been able to break out of close to 70% when it comes to these primaries. So you can still see that there are individuals within the Republican Party who still want to go for a Nikki Haley type candidate. So how much work does Trump need to do when it comes to the general election? And then for Biden, Manus, the big question is going to be how much is he going to get when it comes to an uncommitted vote? In Michigan, more than 100,000 voters came out. It was a protest vote. They said they want to see more when it comes to what is going on in Gaza, and they voted uncommitted. So you can see he potentially has more work to do. And what we'll see in the data overnight from Super Tuesday, more work to do when it comes to shoring up parts of his base before November.
Okay, Anne-Marie, thank you very much. Anne-Marie Horder, and good luck with the next couple of days tracking the political narrative. Rob Waldner and Karen Murphy on my guests this morning. Whoever wins this next election, already in the run-up State of the Union, we understand we're going to talk about tax increases. If former President Donald Trump takes to the helm next year, we could be looking at more debt from either presidents coming to the market. What is the biggest, most material risk, Rob, from a debt perspective in the next presidency?
Well, I think from a market's perspective, what we'd really like to see, we have this sort of rerun of the 2020 election. What we'd really like to see would be more of a, a split government, because from a debt perspective, generally, a split government spends less, creates fewer deficits than a government which is entirely controlled by one party. So that's, as we think about this election, that's kind of one of the things we're thinking about is it a split government or is it one party? And we have different outlooks based on those two things. So, right now the deficit is expected to run about 5 to 6% of GDP for the next several years. Mm-hmm. We certainly don't want to see that number going up. We have a primary deficit of close to 2% of GDP. We want to see that work down towards zero, not up from here. So if we got a significant tax cuts or we got a lot of spending, that would probably be a big problem for the fixed income markets.
And Kara, you do focus on this in terms of perhaps a bigger and more vexating issue for the bond market. We saw it play out once or twice in other global bond markets. People keep saying to me, Manus, we are miles away from any exogenous kind of shock as you had under Kwarteng and Truss in the United Kingdom. But you talk about the numbers, and they can be quite daunting, but this bond market seems fairly immune to them for now.
I think you're right. And I think this is the big issue that people are just not talking enough about. So for many years, I've had clients ask, what about the government debt? And for many years, it was the bond market has been allowing the U.S. government to borrow with impunity, right? We've been able to have extraordinarily low rates. And despite the fact that the debt relative to GDP was at historic highs, our debt service payments were at historic lows. So during that time period of low interest rates, it was fine. Today, it's not so fine. Interest rates have gone up significantly. Borrowing costs for the U.S. government have risen significantly. Now you throw on a presidential election in a year when we need to refinance about 30% of all U.S. government debt. That doesn't even include new debt. And then, by the way, voters don't fully understand that the U.S. government has very little ability to change its spending. I know here we're talking about potentially tax cuts or increased spending, but even the ability to sort of cut spending from where we are today is very, very limited. So this is a really big challenge if interest rates stay where they are.
And if they stay where they are, Rob, I just want to close off with this. The dollar has had a phenomenal outperformance predicated on a number of factors. One is the uniqueness of the US's strength and economic strength, but also in the shaving back of the rate cut narrative to 3, which is where you're at the money. Does that cyclical dollar strength endure? Is the dollar a hedge going into a political vortex, one could say, towards the back end of the year?
Well, I think that the dollar strength is going to key off of the Fed. So if we get the Fed to really ease more aggressively than kind of we're expecting, which would be more than 3 cuts or so, you would definitely see the dollar coming off. Cyclically, the dollar is relatively strong, So we should be in a kind of environment where, as the Fed cuts rates, if the U.S. economy is slow, that U.S. exceptionalism that you were talking about in the economy will kind of leak away a bit, and the rate, the carry in the dollar will come off a bit, and that should allow the dollar to come down.
Okay. Thank you very much, Rob. Thank you, Rob Waldner and Karen Murphy. My guest this morning on Super Tuesday. Coming up, we've got your morning calls. We've got Schwab's Omar Aguilar joins me around the opening bell. We're going to look ahead to Chair Powell's testimony and the key U.S. economic data and conversation right ahead on Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Markets are more under pressure from the tech narrative rather than the spike in yields caused by Bostic yesterday. Just take a look at Tesla at the bottom of your screen now, down nearly 3%. In 2 days, if it carries through, you're going to be down 10% on Tesla. And that is to do with China woes, China sales, and a closure of their factory in Germany. Stocks are set for a lower opening. We're going to test the mettle of the growth to value narrative as we look at these bond yields in a higher for longer narrative. Some of the scribes from Wall Street give you these notes to chew on. Wolf Research upgrades AT&T to outperform, highlighting an improving capital structure and an attractive valuation. Next up, Loop Capital downgrades Williams-Sonoma to hold, recommending investors stay on the sidelines until there's a better entry point. And finally, August downgrades Philip Morris to hold, expecting a notable decline in tobacco usage due to rising prices and mounting health concerns. Coming up with me, we're going to talk about these markets, growth to value, Tesla, Apple, all the challenges and the headwinds in the tech space. We have Omar Aguilar, he joins me, on how consumers will start weighing the economy, the outlook in a higher for longer narrative right here on Bloomberg.
Trends in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Jobs Day, and Bloomberg has the report under surveillance.
We've had unemployment sat at 4% for 2 consecutive years.
This is a two-sided sword. There is a softening in labor demand.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is a very strong labor market.
The White House has got to love this.
This is something huge they want to run on.
Where is the slowdown?
If you look at the reality, it ain't showing that.
The February Jobs Report, Friday on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Certain days, the news flow on technology in China and doing business with China labors on these markets, i.e. the news flow on Apple and their sales, Tesla and their sales and production. That is what's dragging these markets lower, not the mini pop that you had in news yesterday. We're rolling over to the cash open. We're lower, but still holding above the important 5,100 level. NASDAQ is down, and the broader equity market now in the Russell down by 0.6% as the market grapples with higher for longer. We've changed up the complexion. Bitcoin, 67,649. The actual market capitalization of this cryptocurrency has hit 1.35 trillion. So we are looking at a momentum here in the crypto narrative and the risk-on narrative. Yields are coming down this morning. This is a post-Bostic retracement as Raphael Bostic floated the idea of one and done in the third quarter in terms of rate cuts. The market is coming back again, down by 6 basis points. And gold actually makes an all-time record high. That is just worth noting. It's rallied by $100 in the past 5 sessions. One stock to watch at the open, it is Target. The retailer topping its fourth quarter estimates thanks to improving inventories. Abigail Doolittle is with me. Abby, take it away with Target.
Well, the stock is reacting so well, I would say that investors have that old Target feeling this morning. The stock is having its best day since November of last year, up more than 10%, having a lot to do with those improved inventories. That meant that gross margins were nearly 300 bips or 3% better than what was expected, or excuse me, than the estimate. And one analyst saying outperforming even by another percent. That flowed right through to the bottom line. They put up nearly $3 in adjusted earnings. That was 27% better. Sales roughly in line. So again, speaking to that inventory improvement, having less to do, having to worry less about marking down. They also were able to take care of shrink to some degree. Relative to what's been going on, so of course there was a low bar coming into this quarter, expectations of same-store sales down 4.5%. They beat that just slightly, down 4.4%, but we'll take it given the fact that over the last year, the shares of Target really underperforming to the peers. At this point, now flat, but into today over the last year down relative to Walmart up about 28% and the consumer discretionary space up about that much too. Now you have to wonder if they can continue this outperformance for margins and inventories. Manis, will Target have that big catch-up trade?
Okay, well, they're certainly flying high this morning. Abby, thank you very much. Let's turn our attention back to tech. We'll talk about it this morning. iPhone sales in China are falling 24% in the first 6 weeks of the year, and that drags the Apple stock lower again. And it's a 1-2 punch for Apple this week between fines in the European Union and the pressure in China. Where is that pressure in China coming from?
Domestic handset makers, and also an economy that seems to be showing more signs of pressure than perhaps we realize. This is data from Counterpoint Research, and it looks at the first 6 weeks of the year relative to the same period a year ago. So Apple's iPhone sales in China fell 24% in the first 6 weeks of the year relative to that same 6-week period in 2023. And what's interesting about it is that on the domestic handset pressure side, Huawei saw its sales grow 64% in that same 6-week period relative to a year ago. And so what you're seeing is shifting dynamics in market share. Apple now holds less than 16% of market share in the smartphone market in China, whereas Huawei, given the growth they saw at the start of the year, now has more than 16% of market share. And the reason I also bring up the strength of the economy is that overall handset sales shrunk, right? You look at all the different names, some grew, the majority saw shrinking sales in the first 6 weeks. The stock's down 2%, we're trading at our lowest level since October. Interestingly, this is one data point, right? It's the most read story on the Bloomberg terminal, most read story on .com. But the other narrative that's out there is just growing disappointment about a lack of an AI story. Tim Cook promised at the AGM, February 28th, that the AI story is coming. But a part of this, if you look at the comments from the sell side and other strategists, is they look at Samsung, which has talked so publicly about the generative AI capabilities of its latest handset, and they recognize the traction Samsung is getting with that. And they're basically pleading with Apple to say, give us something equivalent that they've not yet done. But yeah, stock down 2%, lowest level since October. And in China, which is, of course, Greater China, around a quarter of revenue, this is a really big problem.
Yeah, and those analysts really are taking against the stock at the moment. Yesterday, it was being removed from Evercore's tactical list, and the list goes on. And thank you very much. Great context around Apple's push lower this morning. Tesla, the same story here. We've got extending declines. This as China's shipments fall to the lowest level in more than a year. Isabel Lee is with us. Isabel, I suppose the debate will rage here as to what pressure Tesla is under to perhaps move out of Mag 7 to turn into the famous 5. Good morning.
Good morning. That's exactly right. And in China, it's proving to be a tougher narrative for Tesla. So it did sink to its lowest in more than a year, but that's because of a sales lull due to the lunar holiday and, of course, renewed price competition. You know that China is the world's biggest EV market, and shares are now down around 2.5%. Tesla shipped 60,365 vehicles from their China factory in February. That's the lowest in December 2022. That's a 16% drop month on month and 19% year on year. But this isn't really such a big cause of alarm, because during holidays, especially the Lunar New Year holiday, which is the biggest holiday in China, millions go off to visit their friends and family, sales are generally lower. And as we know, China's EV market is slowly slowing, which is why Tesla, in a bid to compete with its rivals, have been offering numerous strategies. This includes discounts on some paint colors and also offering subsidized insurance to really compete in the local market. And this is where things get tricky. We have price cuts by major manufacturers. So this is, again, in a bid to boost sales, prompting some customers to hold back on purchases. And that's according to China's Passenger Car Association. So something to think about there, Manus. It's kind of like a cycle. You wait for a discount, but then you don't buy because you hope that it'll grow, the prices will become lower. So definitely something to think about. For now, shares of Tesla are down 25% year to date, Manus.
Isabel, thank you very much. Yeah, it's like everybody out there waiting to jump into the property market. It might not do you to extend and wait. So from EVs to semiconductors, US officials are telling AMD that AI chips meant for the Chinese market, they're just too powerful to sell there, at least without a license from the Commerce Department. It's a tough old one to sell, isn't it, Simone, to the Commerce Department?
Yeah, and it's been a tough path to navigate for AMD, as it has been with the likes of NVIDIA, as well as they try and get around that 2022 ban on selling their best AI chips to China. So sources telling Bloomberg, who was first to report this news, that AMD was looking to launch a version of its MI300 flagship chip called the MI309 that would have been compliant with these bans in China. But apparently Commerce Department now thinks that even this chip has too much juice. This mirrors what we've seen with NVIDIA, for example, which went out to the market with what it thought was a compliant chip. Then the Commerce Department said, actually, that's a little bit too exciting for us. They tried to further restrict that, and they've continued to face questions about whether the Commerce Department will allow them. The good news for AMD is that it's never really been quite as exposed to China as its competitor NVIDIA. And Bloomberg Intelligence writing this morning in a quick reaction, this isn't likely to impact near-term sales estimate for AMD or its 3.5 billion AI GPU outlook for 2024 because its main buyers are in North America. That said, this news is weighing on shares today, down 1.6%. But I think you back out the picture, you look gains of nearly 37% so far this year and 151% in the past year, Manus.
Pretty spectacular, Simone. Thank you very much on the stocks this morning. My next guest is Schwab's Omar Aguilar, joining me to discuss this. We've just been through a litany of angst from Apple, AMD, and Tesla. This is a market that is disturbed about doing business in China and with China. Is it a healthy wake-up call at the moment that this is what you should fear in the tech market rather than incrementally higher yields?
Well, good morning. It's clearly the macro environment, tends to have a big role in the way that, markets behave. We have been, consistently focused on two things. What is the macro environment that allows these companies to perform and generate earnings? A lot of the companies that you mentioned, have been incredibly successful in generating significant amount of cash flow. But at some point, as you actually get to certain levels of market cap and certain levels of earnings, you basically end up having a road that is less linear than it used to be. I think a lot of the headwinds that they see from their business overseas, and particularly because of the disparity between the U.S. economy and the rest of the world, you can actually see how that eventually becomes a headwind for many of the companies that have business internationally. I think the situation in China in particular, where the economy, has a significant amount of impact on a lot of the technology companies that we have in the U.S., anything that happens macroeconomically in the Chinese economy tends to have a significant event of potential earnings for these companies.
And of course, today we've heard this reaffirmation from the National Convention in China that they're going to stick with the 5% target. Omar, I'm drawn to your descriptive there about the road ahead being less linear. And one of those obstacles on the less linear pathway is, of course, savings. And you make this point very clearly. Excess savings have fallen from just over $300 billion. To just over $300 billion, and that's down from $2 trillion in the summer of 2021. So you talk about this level of exhaustion in the 2 months ahead without wage growth, and this will slow down the economy in the second half of the year. Now, I've heard various people talk about this, the running out of COVID savings. What I want to get a sense from you is this going to be a slope of a slowdown, or are we going to face some kind of a cliff-like moment for the consumer?
Yeah, well, it is an interesting, dynamic because the consumer is also not just one big block, and it's sort of you can break the consumer landscape into 80% of the earners that tend to have a significant amount of really strong balance sheets that continue to have solid savings and continue to have significant amount of well-balanced consumption patterns to their savings, and that's critical because for them the amount of debt, the amount of consumption doesn't really affect their personal lives. On the other hand, we have 20% of the lower end of the consumers that have seen the significant impact of higher interest rates and the disparity between their consumption patterns and their wage growth, because their consumption has gone higher than the levels of earnings that they're getting, and that's where you're starting to see this stress. That's when you see a little bit more of the delays in credit card payments. That's when you're starting to see potential issues in car payments or potential delinquencies on some of their mortgage payments. payments. So the good news for the U.S. economy, however, is that 80% of the consumers that are well balanced, they tend to have mortgages that are funded at a very low rates and they're locked in. And that's one of the reasons also why the housing market has been fairly stable, because there hasn't really been that much turnover, and the wealth effect for that part of the consumer is still, pretty robust.
I just wonder, when I look at the length of gains and runs higher that we've had, 16 of the last 18 weeks, we've seen these markets, U.S. equity markets, run higher. We haven't seen that since 1971. Is it too late to go for breadth? You advocate in this soft landing scenario that you want to go for small caps, value stocks, etc., real estate. It's never going to be too late. You either participate in this market with a medium to longer term view, but I just wonder, it is so breathlessly high at the moment. Are you waiting before you deploy? Are you incrementally joining in those sectors?
Yeah, we always advocate always look at the long-term horizon and think about, what would be, your long-term strategy, and not necessarily try to find that timing where you can actually get in or get out. In fact, we try to always advocate our clients to just try to find pockets of volatility where they can use to rebalance their strategies and get them closer to their long-term objectives. Now, one of the points that you made, which is clear, is that we have seen a significant amount of rally since the low in October of last year, and it's been roughly 25 to 26% of market rally since then. Now, if you recall, a majority of the gains in last year in 2023, and also the majority of the gains this year, have been heavily concentrated in a lot of those top 10 names in each one of these market indices. So in many cases, what that does is it opens the opportunity for other companies that actually catch up and contribute more. And that breadth of potential contribution is something that we all expecting to at some point change. What is important right now is that outside of the headlines of those indices that are heavily driven by a few names, it is to actually find the opportunities when valuations still look attractive, and then can potentially bring you opportunities for investing.
Okay, Omar, thank you so much for being with me this morning. Omar Aguilar, my guest on the markets. Coming up, Apple takes a hit, quite literally, in China.
Huawei is coming back, and Apple is probably going to lose significant share in China.
It's the Chinese consumers' impact on Apple, next on Bloomberg.
Names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
If you look at Apple, really it's a competition, it's mostly a competition issue. So Huawei is back in China. They were not able to do phones for quite a while because they couldn't access chips manufactured at TSMC anymore. Now they figured out a way to do chips domestically on mainland China. They are back and Chinese consumers like to buy Huawei phones.
New data revealing that iPhone sales have fallen by 24% in the first 6 weeks of the year. It's a similar story for another market, darling, Tesla. That's what we've been saying. China vehicle shipments plunging to the lowest level in over a year. Team coverage, deeper dive. Ed Ludlow and Craig Trudell join me now. Ed, if we've already talked about the fines that have been levied against Apple and about the drop in sales inside China, does this put more pressure on Cook to diversify the demand cycle into India and other emerging markets at lower price points away from China?
Well, it's an interesting argument because if you look at the data, overall China's handset market, smartphone markets sank. And those that did better, you could say, okay, well, Huawei had an enormous jump in market share. It is more competitively priced than an iPhone handset, but some of the more budget names also had very modest growth or saw a sales decline. Tim Cook and Apple have always talked about India as the kind of sleeping giant, growing middle class. I remember 10 years ago being in London with you, we would talk about this idea of a growing middle class in India being a sleeping giant. 10 years on, it hasn't really come to fruition, but you see Apple investing in physical stores in India, developing its online marketplace. The story with Apple is kind of idiosyncratic in the sense that they're facing three threats, right? The domestic pressure from those handset makers, a difficult economic environment in China, but also the downward pressure on the stock right now very much relating to a lack of story in AI. That really seems to be the anxiety of the street.
Well, let's see whether they manage to turn that around. I mean, there is more pressure on Cook than there has ever been. Craig, good morning. Good to see you. So here we are with Tesla. We know the incremental lashings that Tesla has had. Nancy Tengler was with the Bloomberg Brief team this morning, myself and Danny, and she said, we are misunderstanding what the depth of value is within Tesla, and that is, it is about the batteries, it's about the plants, and that must be remembered for the longer term valuation narrative. She bought it at 104, she sold it over 200, and she's tipping her toes back into this market at these prices on the dips. Can you help me understand why Tesla, we need to perhaps look a little bit deeper than the headline incentives that were being offered to buy one?
Well, I think Isabel hit it well before the break, talking about the idea that, we shouldn't overread into any 1 month's results in China, especially the month of February, the fact that you do have the Lunar New Year having an effect on the month. That being said, this was a pretty bleak result, and I do think that there is a sort of, overarching theme that we've been seeing for weeks and months of EV slowdown that's given people real pause, some sort of unintended consequences of the effect of really slashing prices at Tesla and the effect that that's had on resale values. I think much as there's a lot to be said for the promise of Tesla, whether you want to look at it as an AI company, the fact that it brings a lot to the table outside of cars potentially in terms of battery player and energy storage, and a lot of buzz around the Mega Pack product. self-driving development that Musk has talked a lot about it being the sort of long-term driver for Tesla. I think the market was much more willing to entertain those things in a zero interest rate environment because Musk himself will like to talk about the idea that we make the impossible merely late. That he's been able to accomplish an awful lot with this company, but it tends to take him more time than he says he needs. I think the fact that Tesla has had so much of an issue with delivering on a lot of his promises leads to this sort of bang on the head when you do see some operational issues like we've seen in China and like we've seen just in the last few weeks in terms of disruption to their production, even here in Europe and in Germany, which we're seeing again today.
Or is it that, as we mere mortals lack the imagination to comprehend flying taxis on Madison Avenue? Get the shopping done. Ed, thank you very much. I'll leave you with that thought on the West Coast. Craig Trudell in London. A little bit of breaking economic news coming across the Bloomberg terminal. Abigail Doolittle joins me with that. Abby, what have we got?
Indeed, we do have some of the final PMI, U.S. PMI data for the month of February coming in better than expected. For the S&P Global U.S. Services PMI, the actual was 52.3 versus the survey of 51.3, a little bit better than the prior. And for the composite, 52.5, also coming in better. This, of course, is in expansionary territory. Below 50 would be contraction. And we have the ISM services coming up today at 10 a.m. The estimate there is for 53, maybe setting up for those larger companies a little bit of strength there as well. Relative to sectors, Manus, we are looking at a 0.5% decline for the S&P 500, and it's that heavy tech weight, consumer discretionary and services indexes. Those are really weighing today on the S&P 500.
They are indeed, and tech is dragging us all into the bottom of this market. Coming up, market moving events for your day. We'll set up your trading diary.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
The week ahead looks like this. Fed Chair of Supervision, Michael Barr, speaks this afternoon. Plus, all eyes on the polls, Super Tuesday. And then it's Chair Powell testifying on Capitol Hill on Wednesday and Thursday. Thursday night, President Biden will deliver the State of the Union address. And Friday, you got it, it is the jobs report. That was countdown to the open. Tech is under pressure. Apple is down 23% this year. And Tesla also.
UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the Gel Razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups, is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. This is Bloomberg Intelligence Radio Program. Alex Steele is out today on assignment. Billy Lipschultz sitting in for Alex to cover us for the next couple hours, so that's good stuff. Bloomberg Intelligence, we like to focus on companies, we like to focus on stocks, and we like to rely upon the 400 analysts that work for Bloomberg Intelligence. Bloomberg Intelligence is the investment research business for Bloomberg LP. We've got some of the best research analysts on the street covering 2,000 companies and 130 industries around the world, and we tap into their expertise over the next couple hours. We'll do that. Coming up, Anthony Nieves, chair of the ISM Services Committee. He's going to join us on that ISM data. We're also going to talk to Anurag Rana from Bloomberg Intelligence on Apple. They got a problem in China, folks, really impacting their phone business. And they're going to do a radio TV simulcast today. Gabrielle Kahane, Arc House CEO. Arc House are the folks that are bidding for Macy's.
that department store. So we'll get the latest from there. But first, let's kick things off this hour with Mr. John Tucker at Bloomberg Business Flash.
All right, thanks, Paul. And we are brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low, transparent commissions. Learn more at ibkr.com/bonds. Stocks right now are lower. Treasury yields also lower. Apple iPhone problems in China deepening. Advanced Micro Devices hitting U.S. roadblock and selling artificial intelligence chips to China. And Tesla extending its decline as its China shipments, they slump. Those three things dragging stocks lower today. Investors also waiting to hear from Fed Chair Jerome Powell. He's delivering his semi-annual testimony to Congress starting tomorrow. He's expected to double down on the message of higher rates for longer. Meantime, David Rosenberg of Rosenberg Research says no matter what the data say, the rate of inflation is coming down.
My big concern is that it's the service sector that the Fed is most focused on, and that is the most unreliable components you have within the CPI and PCE deflator. So I say look at the prices of the things you can see, touch, and feel, and they're actually in a deflationary momentum, and I expect that will persist over the next year.
And right now, the S&P 500, 20 points lower. It's down 0.4%. We're at 5111 on the index. The Dow Jones Industrial Average, 128 points lower. That's down 0.3%. And the Nasdaq 100 right now down 189 points. That's a decline of 1%. The 2-year yield 6 basis points lower at 453. The benchmark, the 10-year, that's down just about 10 basis points. We are at 411. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Bailey and Paul.
Hey, John Tucker, thank you so much. We appreciate that. Bailey Lipschild sitting in for Alex. Alex Steele, she is on assignment today. Bailey, thanks for sticking in.
Calling
for
the
couple hours.
bullpen, yeah,
yes.
just for 2 hours, though, so it'll be quick.
That's right, bringing in the young right-hander from the bullpen. We are here in our Bloomberg Interactive Broker studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast. That's the best way to do it. Tom Keene has been adamant about trying to make it easier for folks to find the Bloomberg programming on YouTube, and Bloomberg Podcast is a search item. That'll get you there. Had some ISM data come in today. Services side, a little bit weaker than expected, although the new orders were higher. Let's break it down with Anthony Nieves, chair of ISM Services Committee, joining us via Zoom from Los Angeles. So, Anthony, I'm looking at the ISM Services data come in a little bit lower than last period, a little bit below expectations. What are your takeaways?
Well, when you look at the composite index at 52.6, it's actually up slightly from the 12-month running total of 52.4. And what's actually dragging down the composite index is the contraction we're experiencing from the employment index as well as supplier deliveries. And that's attributed to deliveries. We have improved capacity, some logistical challenges, but overall less backlog than what we've seen in the past, just improvements all across the supply chain. And the employment continues to be a mixed bag, with companies managing that variable expense as well as having difficulty in backfilling some of the open positions that have been within their specific companies, respective companies.
And Anthony, I'm looking at it, some demand measures, though, strengthening. So gauge of new orders placed with service providers increasing to 56.1. That's the highest since August. When you look at that data point and some of the trends underlying it, what can we make from demand in those orders being placed with service providers?
Yes, when you look at new orders and it tells us what's in the pipeline, the one thing we have to keep in mind is that the cycle time for orders on services is it's less than what you would see on the manufacturing time, just from the nature of the different businesses that make up the industries and the industries that comprise the sector. But overall, it does tell us going forward, it is a leading indicator that we'll see this continued trend. We've seen this composite index stay in the middle to low 50s over the last 12 months. And it's just at sustainable levels, and we've not seen any head fakes or anything that might distort the picture going forward.
So, Anthony, we know services are critical to this U.S. economy, probably approximately 70% of the U.S. economy here. Are there regional differences that you see in your data?
We don't measure it regionally, but we can tell by the companies that comprise our survey committee. So we can see the different areas, and we know that certain things will impact, demand as well as the throughput, and it's based on the geographic location and the effects of weather and different variables such as that. But overall, the way that we comprise this survey, it's based on contribution to GDP, percentage-wise, and it's small, medium, and large companies across all of the 18 industries. So we really mirror what we see on the trailing GDP figures. So it maps closely over time.
How about that services employment data? The employment data came in at 48 on the index. The consensus was 51.4. Last period was 50.5, so noticeably lower. What do you make of that?
Yeah, I look at it and I see that, we had a decent number in November. It pulled back in December. To me, that was more about cycle time and the holiday season, and things kind of slowed down traditionally there historically. And we had a nice little pop-up in January. Now it looks like it's a combination of wariness, and I'm getting this from respondent comments. They're saying they're a bit wary as to what's going on, and so they're managing that expense, and others are saying they're just having difficulty finding applicable workers to their open positions.
And Anthony, individual data points are important, but the underlying trends are really what kind of drive expectations. What are you keeping an eye on, and what trends stand out to you when you put this batch of February data points into context?
The key things are, and looking at the four indexes that make up the composite, and we know that employment also drives this sector, but I also look at some of the specific industries, the top four, as well as wholesale trade, because this sector is so reliant on the intermodal as well as the distribution channel. So it tells me what kind of activity. So looking at the leading indicator of new orders and everything else, and to your point earlier, when you said about the demand is still there, and we're still seeing this sustainable growth moving forward here for this sector.
All right, Anthony, thanks so much for joining us. Appreciate getting your thoughts here. Anthony Nieves, he's the chair for ISM Services Business Committee, joining us from Los Angeles via Zoom. And again, the ISM Services Index came in at 52.6. Put that in context, the consensus was 53, so a little bit below consensus, and it was about 53.4 last period, so below last period, although as Anthony pointed out, it's higher than the 12-month trailing average of 52.4, so showing some consistency if nothing else. And again, the key point, it's above 50, showing that the services economy is growing. So breaking down the news there. All right, looking at the markets here, the S&P 500 is off 0.5%, NASDAQ off 1.25%, and the Russell off about 1.3%. Let's check in with Nora Melinda. She covers the equity markets for Bloomberg News. She is a proud graduate of the University of Virginia. And boy, did my Dukies put the hurting on UVA. I'm just pointing it out.
No.
That's the reason you brought it up.
Exactly.
So you just had to flag it for that reason.
Exactly right.
Wahoo wah.
So what are you looking at here in the marketplace, Nora?
Well, we've got a couple of retail names reporting, and I wanted to take a look at Target. Now, that company is rising this morning. Those shares are up as much as 13%, seeing their best day since November. The company said that it sees 300 new stores opening over the next decade, and it reported fourth quarter profit that beat expectations. And we know this is kind of in the midst as multiple companies and retailers have been reporting. We've been hearing from Best Buy, Kroger, and Costco set to report later this week, but we've been hearing from Walmart and a couple other companies that have been doing pretty well during this time. Target said that it reduced inventory by about 12% for the fourth quarter, which was better than analysts expected.
And Nora, that's the best performer in the S&P 500. One of the worst performers, though, you're keeping an eye on. One of the biggest drags, though, is Apple.
I know,
down
what a big name.
2.8%. What's going on?
Yeah, so those shares are down as much as 2.9%, the lowest in almost 5 months. And this is all coming after those sales that we've been looking at in China. Of course, this is the one thing that everyone's really been paying attention to. But we're really still seeing a drag here. Those sales in China falling by a surprising 24% over the first 6 weeks of this year. And as we think about the iPhone, some people are saying maybe it's a little bit outdated. It's been a product that's been around for a while, but it really hasn't seen that pickup in China that we really want to see here.
Well, I guess some of the issues, we'll talk to Anurag Rana from Bloomberg Intelligence a little bit later this half hour and get the breakdown there. But the challenges there are, A, the economy's weaker than expected. We got some more data on that today, just about the Chinese economy and the consumer. B, I guess is, just the competitive aspect. It's become a much more competitive market with the Huawei product. And then C, the one that really worries me is it just a change in consumer sentiment, a part of the Chinese about Western brands? And are they more reluctant to buy a Western brand here, particularly on the technology front? I don't know how to quantify that, so we'll talk to Anurag on that. But that's the real big concern, I think, is just China.
And we always talk about the Magnificent Seven. Looking at that index, up 13% year to date. Tesla down 27%. Apple down 12%.
Yep.
So kind of a dichotomy even of those big tech names. And then, Nora, you were keeping an eye on a smaller tech name.
Yeah, and honestly, I wanted to say when you brought up Tesla, it made me think about the whole news that we heard recently about Apple ditching its efforts for EVs. So it's like a lot of things that we're really looking at here in the Apple space. But as you mentioned, I am looking at a smaller tech name here. That's GitLab. Those shares are down as much as 20%. Now, I was looking for some size and scope on this, and it actually isn't that dramatic. It seems as though this company has been falling for quite a few days. But this is a San Francisco-based software solutions company. It gave a full-year forecast that was weaker than expected. Analysts are saying that the outlook overshadowed otherwise strong results, and we had an analyst over at RBC saying that, quote, while we expect lower beats than historical levels, we believe that there is room for upside.
Interesting. So GitLab is a company that's getting about a $10 billion market cap stock. GTLB is the ticker, off 15% today. Flat year to date, and on a trailing 12-month basis, up 20%. And as you mentioned, RBC's out there.
Yeah.
Trying to defend the stock. Man, it's lonely out there. Trying to defend something that's just getting hammered.
Well, it reminds me, was it last week, 2 weeks ago, where we saw Palo Alto Networks getting beaten down, and then you saw people buying the dip? The question, though, are you catching a falling knife? And when you look at kind of this chart, still, as you mentioned, on a relative basis, trailing 12-month average, or 12-month basis up 20%. So
like this is kind of a thing, like the stock's at 62. I'd be really happy buying stock at 67.
Yeah.
I mean, I don't need to buy it. I don't need to be the hero and buy it, where I think it might be the low. I'd rather see some other folks go out there and try to be.
Do it first.
Exactly. All right, Nora, thanks so much for joining us. Norma Linda of those troubled Wahoos at UVA.
Hey, now.
Coming on. So we'll see. It's ACC Tournament Week coming up next week.
He's kicking me off.
It's fine. Syracuse is going to do what they do sometimes, and they're going to go on a run. They'll beat UNC,
I forgot you're in the ACC.
And I'll cheer for them just out of spite.
Bailey, what are you looking at in the markets here today? I want to ask you about just kind of where we are in the new issue market. What's the chatter here? What are we waiting for? We had something this week, didn't we?
We're expecting Reddit probably early next week. We did see them set the price range. Bloomberg matched the report from the Journal that they were targeting an upside of that marketed range at $6.5 billion, though they haven't formally set that price range. That's what we're expecting in the week ahead. But a lot of cautious optimism, really, Paul, over the last year at this point about new issue market coming back. But we are seeing a number of block trades, number of convertible bonds being launched, as well as secondary offerings. So underlying fundamentals are strong. It's just the kind of question around who wants to go first and who wants to be that guinea pig.
So Reddit's the big one. Are there any other ones out there that are kind of people thinking about?
Well, Astera Labs is another one. They're tied to the AI machine learning space.
That sounds exciting.
So that's another exciting one that kind of can capture the imagination. It's really just kind of an expectation around, will Klarna go potentially in the second quarter? What will the reception be to that? We've been talking at length about Stripe and Databricks and a lot of these big technology companies. But the consensus I get when I talk to bankers is they see strong fundamentals. But the best companies don't need to go public. They can raise more cash in the private markets. So if you can do that, why go out the door?
Yeah, I mean, that's kind of what we've seen over the last, 4, 5, 6 years. I mean, a lot of these tech companies, to their credit, are, when they do come to the public markets, they're coming with much stronger fundamentals because they were able to fund earlier stages of their growth in the private market, so they can afford to wait, as opposed to past tech cycles where maybe they were coming out, too early relative to expectations with not the profitability numbers. So, but the market, I mean, we're up 7-8% year to date on the S&P 500, up 3 or 4% on an equal weighted basis. So there is a lift here to this market following the strong end to 2023. Yet I don't feel people are that aggressive on the marketplace here. We've seen some Wall Street banks, kind of see some divergence, pulling back on their guidance for the S&P 500 on their targets. Some kind of saying, no, stay the course here, but a lot of uncertainty out there.
And that's one of the big things. We look at an index that people were kind of pounding the table for coming into this year, and that was small caps. And small caps has really been left in the dust. Again, whether you want to call it the Fab Five, the Magnificent Seven, whatever have you, there's a lot of excitement around AI and what that can bring, but there's still, to your point, is uncertainty around what the next driver can be. When you look at a lot of the underlying signals, there's a lot of optimism, a lot of bullishness, but when you still haven't seen those Fed cuts play out, and there still is kind of an expectation around how far will Jay Powell and company extend rates where they are, and how does that impact the forward-looking expectations, that's where you're seeing some of this, I would call it, broader hesitancy.
Yeah, absolutely. I'm looking at the Russell 2000, up about 2% year to date, lagging the S&P 500 again, up about 7 or 8% here. So the small cap's not quite keeping up with the broader market here, and that's one of the signs that you'd like to see for a broadening out of this market, and maybe a health of this market is seeing some of the small cap names. It's still dominated by the big cap tech names.
And I do want to call out that Bitcoin did hit an all-time high.
That was
Tom Keen's not
in
the studio, so we can talk about it, but quite the
I mean, we're at 68,400 here on Bitcoin, up 1.4% intraday.
61% year to date.
Yeah, just extraordinary. And it's the halving, H-A-L-V-I-N-G, limiting the supply growth going forward. That's happening, I believe, in April.
Yeah.
So you've got that limiting in the supply, and then you've got the spot ETFs, presumably increasing the demand for it. You put that together, and that is the makings of a bull market, and that's what you see here. So we tapped 69,000 earlier today intraday, so just extraordinary. We'll have more coming up. This is Bloomberg.
bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Networks, Intel, some of the worst performing stocks in the S&P 500. Then you have shares of Target, up over 12% right now. Their fourth quarter profit beating estimates. Monetary policy also in focus. The Fed.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
Sales plunge. Let's break it down with Anurag Rana. He's a senior technology analyst at Bloomberg Intelligence, joining us via Zoom. Anurag, what's causing this decline in the early part of 2024 in iPhone sales for Apple in China? Is it market share lost? Is it a contraction in the market? What's going on?
I think it's a bit of both for them, and this is the same story that's been going on for the last 6 to 9 months, ever since Huawei released their higher-end phone last year. So Apple's been losing market share there. That has been, you could say, deepened or coupled with consumer weakness in China, and it's all that's, driving this problems right now.
And when I look at the PGEO function on the terminal, iPhone accounts for more than half of Apple's revenue. China, call it a fifth of their sales. Anurag, when you look at those numbers, what does this actually mean for Apple if they're going to see that competition eating into their sales?
Yeah, I think it's going to be a tough time for Apple in China for at least this year and maybe into next year before they can, let's say, make some inroads in India and other markets. Emerging markets is the real growth driver for Apple. There is no two ways about it, and iPhone is the big growth driver. So if phones are not selling in China, that's a problem for Apple. It means numbers need to come down even more for Apple this year. We saw about double-digit sales drop in China last quarter. I looked up this morning on MODL. Consensus is about 7% drop in China for this quarter. I think that number needs to creep up to somewhere in the low double-digit decline going forward. So it's a painful situation for Apple, and frankly, there aren't that many rosy things looking forward, at least for 2024.
So I guess the biggest concern for Apple obviously is competition, because they haven't really had that robust of a competitor in their part of the market. Are there any responses Apple can make here from a competitive landscape other than lowering the price point?
Yeah, Paul, I think there is a little more hype in that competition news than reality, only because Huawei didn't release a phone for many years. So that you can think about it, if you have an install base of Huawei phones, I mean, let's say, that's X, and that hasn't been updated for 4, 5, 6 years, and you just suddenly get a brand new phone, all of those people are going to go and refresh that. So I think you should take that as a bigger factor, plus the subsidies, they are local providers. So I think Apple will do okay in China over the long term, but I think that's not going to be a 2024 story.
And you mentioned emerging markets as the next driver. What countries, what regions are going to be able to pay up for what I would say is quite an expensive phone?
Yeah, I think that's the most important question. And I think, just by the sheer size of it, India is the next one. But frankly speaking, right now, Apple doesn't even operate in 5% of the entire market because of the price point of the phone. I think the strategy in India is going to be a mix of the lower phone, the SE, as well as the refurbished phone where the price point is even lower. But having said that, I think India is a developing country. The middle class is getting more richer. So I think that's going to be the next big growth catalyst. But it's not going to play out in 24, 25. That's more of a, I would say, mid to long-term story.
So is there a thought for, we've talked about this before, that Apple might introduce a lower price phone into India for just that reason. Is that something they're still considering, or will they just wait for the market to kind of move up to where the Apple phone price point is?
I think it's going to be the latter. I've done a lot of analysis of how much share they can gain if they drop the SE price by $50, $100. And when I published that stuff, I think that year they actually raised the price by $50. So they don't believe in dropping prices. They are more on a margin story. So think of Apple more on the long-term basis right now, not on the short term. I don't think they're going to, I would say, swap margins for market share. They've never done that in their history, whether it was on the Mac side or on the phone side.
And quickly, Anurag, I look at the news. There's no more Apple Car. There's tepid reception to the Vision Pro. What actually drives the stock? What drives sales in the next 12 to 18 months?
Yeah, I think that's the most important question for Apple investors. And I think there's going to be an event in June, the Worldwide Developers Conference, where they have pledged that they're going to show a lot of AI enhancements to the operating system. I think that really is the one wild card that can completely change the sentiment of the company, both in terms of sales and the gloomy investor sentiment. Only because, remember, Apple has a distribution network that stands, next to nobody out there in terms of, affluent people using their phones, more than 1 billion devices connected just on the smartphone. I think that really is the big driver. One of the things I was thinking about was if you go back, 5 years, 7 years, there were apps such as TripAdvisors and Yelp where people used to go for their, specialized functions for restaurant advices and tourism. But when you look at somebody like Google, a lot of that traffic has moved on to them because they control the distribution. I think Apple has the same ability, but they have to show up with some AI products. Otherwise, that's not going to flow.
All right. Anurag Rana, thanks so much for joining us. As always, Anurag Rana, Senior Technology Analyst for Bloomberg Intelligence. In just moments, we're going to bring you an interview. Our own Katie Greifeld, Bloomberg Television, could be interviewing Gabriel Kahane, Arkhouse CEO. This is the Arkhouse and Brigade Capital Management boosted their offer for Macy's by 14% after the retailer rebuffed a previous proposal. So we'll get the latest on this bid and this offer. But there's definitely some interest in Macy's, the brand, the real estate, it's a question of, what do you do with these department stores and these retailers? And we saw Macy's had an announcement earlier where they were going to be shrinking the size of their footprint. So right now, let's go to Katie Greifeld, Bloomberg Television, Gabriel Kahane. He is the Arkhouse CEO on the company's increased buyout offer for Macy's. Let's listen in.
We now welcome in our TV and radio audiences, Arkhouse and Brigade Capital Management, raising their offer to buy Macy's by 14%. Now, Macy's has responded to the offer, saying, quote, the Macy's board will carefully review and evaluate the latest proposal consistent with the board's fiduciary duties and in consultation with its financial and legal advisors. Macy's shareholders do not need to take any action at this time. Joining us now, I'm thrilled to say, is one of the minds behind the offer. Sitting next to me is Gabriel Kahane, Arkhouse CEO, managing partner, and co-founder. Gabriel, great to have you in person. Let's talk about this raised offer, the bid going from $21 a share to $24 a share. Are you prepared to raise it again if Macy's rejects this?
We certainly hope they don't reject it. And they said that they will carefully review this offer in that statement you just read. We sincerely hope that they really do carefully review it in good faith, as they should have almost, I guess more than 3 months ago at this point, our initial offer. And we also think that Macy's shareholders, in that statement, Macy's executives are telling shareholders they don't need to do anything right now. Our view is that Macy's shareholders own this company, and they should do something, which is reach out to their directors, reach out to their executives, and urge them to engage sincerely and in good faith with our credible buyer group.
And I want to bring you a line from the press release that you put